They missed your beautiful monologue.
They've missed my beautiful monologue. Let me take a look. I had tested it before, and life was good, but let's see. I wonder if they hear anything now. I just made a slight adjustment.
I'll do my best to test here.
I know there's a bit of a delay between the Twitter space, the streaming feed, and before it makes its way to YouTube, but hopefully. Okay, sweet confirmation. I am so sorry you missed my monologue of 12 minutes. I'm back here at 11 and Eastern and 1 a.m. I'll be happy to do it again. It's actually part of a 6-page excerpt from something I spoke about at a conference. But in essence, it's underscoring, not to rehash the entire thing, that to be kind to one another. I was explaining to everyone in the Twitter space that I had taken some time off of social media and because of things in my life, and also under the the advice of counsel and I can go into that hopefully in a couple weeks. But that's why I've been a little bit less active. But I came back to such negativity, such hostility, that there was almost 1,000 messages that I was tagged in threads that I hadn't even commented in, started, or even interacted with, that were just so hostile, so negative, uncalled for. The whole notion of ape versus ape is one of the cornerstones of the community, and we all don't have to ascribe to that, but a little kindness, a little respect goes a long way. And I'm just suggesting that people unplug for a couple of days and help gain some perspective. I was talking specifically about burnout, and I was saying that in a professional conference in 2019, I was witnessing burnout, and professionally speaking, and basically the burnout was a waste bucket diagnosis. I mean, it describes a myriad of things, and it's a word I hate, because it's kind of like saying having a fibromyalgia diagnosis, which is, again, in my opinion, a waste bucket diagnosis. Like, hey, something's wrong with you. You're in pain. There's some nerves things. It's transient, it's idiopathic. We can't really find anything wrong with you. We just know you're in pain. Well, we're going to make something up and slap a name. We're going to diagnose it, fibromyalgia. You have it, but it's a Band-Aid. You're treating a Band-Aid. You're not treating the underlying condition. So the notion of burnout, in my mind, is the same thing. And what I was trying to hammer home is that it's about moral injury. That we've been waiting so long, and now we've become accustomed to this, I don't know, adversarial, or the environment that we're in. Whether it be simply social media enhanced, which studies have shown is not quite the case, or rather is quite pervasive, that social media isolates and actually intensifies the feelings of PTSD, anxiety, depression, things of that nature. Doesn't actually bring us closer, and does horrible things for our mental health. Again, underscoring back to moral injury. But I had the opportunity to disconnect because I had a lot going on in professionally, personally, and my attorney said, kind of put a gag on what I can and can't say until some things are closed, which I will happily disclose and freely publish. I was talking to Kenna about that, and when she returns from her unapproved vacation, Karen's still waiting for her to call in and explain herself. But I had some time just to unplug. My phone was off for a couple of days. A storm came through Boston. We had 90-mile-an-hour winds south of Boston, knocked out power. Was without power for a day and a half or two. Have a generator installed in my house, which is great. So the house had everything, but I never banked on Verizon or Comcast failing due to flooding and power issues of their own. So I was kind of blessed because there was no internet, and there's no cell signal where I'm at. So I had a couple of days to reevaluate, reset expectations, reconnect with family, friends, my dog. So all I was saying is, it might be helpful to find some solace, to reevaluate, to go outside, even though it's not the summer, or depending where you live, it's starting to get a little, it's the fall, winter here in New England. Walk the dog, read a book, enjoy the company of others. And this is coming from a guy that's super cynical and really does not enjoy the company of others. But um, it's important. At least it allowed me to have a mind reset and evaluate what's important, change my mindset to be in a good place and not feeling drained all the time, and then to log back in today and to be tagged in nearly 1,000 messages where it's just FUD, hostile, accusations flying back and forth, et cetera, et cetera. So I'm not going to repeat my monologue much beyond that. If anyone's interested, I can actually you can post the transcript of what was spoken at. I mean, it was I'm condensing 6 pages down to what was supposed to be 5 or 6 minutes, but it's been a long day, and I apologize for the momentary YouTube glitch. But in any event, my diatribe is over, so I yield the floor.
It's one of those things that look at. I mean, like I said before, I think it's a really good point. I know that I found myself just engulfed in social media at some points, and it's interesting to see everything flying around, sometimes positive, sometimes negative, and it's just such a fast-paced environment that if you're in it all the time and it's all you pay attention to, it can be a little bit too much. When I returned to work recently, it was a huge change, and I appreciate it much more for what it is, as opposed to being plugged in 100% of the time and just waiting for that next bit of news, whether it's about the market or whether it's about anything else. If you're plugged into it 100% of the time, it can be overwhelming. But I've also noticed the uptick in, I don't know, I don't want to call it negative sentiment necessarily, but just negative comments floating around, to your point. And it's interesting, like you said, it does seem like FUD to a certain extent. Usually when you see an uptick in that, you see uptick in the stock prices, which is what we saw today. I think it was a really interesting day across the market. You had SPY relatively flat. The Russell had pretty substantial gains at about 2.5%. But I don't know about everybody here. I mean, I'd be interested, Kringle, in your perspective, and others that are listening. I saw a lot of just 5 and 10% movers that were seemingly out of nowhere, and some that bumped 15% and ended up at 5. It just seemed like a very interesting day in the market, and I think it'll be an interesting week this week with Jay Powell speaking on Wednesday. We've got something to look forward to there, maybe not look forward to there, with the expected announcements. But yeah, interesting day in the market.
I agree. I was kind of overwhelmed with the social media aspect, but I only was following a few of my positions throughout the day because returning to work was or catching up on some work things despite taking the week off was just a disaster. But this is open mic, so anyone who has a question that wants to speak, by all means, raise your hand. We're happy to bring you up. I think Halister and I were interested in Kringle's outlook, given what his speculation is on upcoming news.
There's nothing much that is really exciting the latest weeks that I've seen, at least at my workplace. We figured out that the Fed really likes to kick the can down the road as much as they can, while they allow some of the institutions to deleverage some of the risk they have on their portfolios, and that we have some trackers about Congress withdrawing some of their long positions. then it's we think that a correction might happening by Q2 by next year, but it's really hard to say given the circumstances on how inflation affects us all. And also, there's a lot of people, asking me where I've been for the last week or two. I've been withdrawing also from social media because there's no use for me to actually give some due diligence because there's really nothing new. Because everything that we have been teaching you guys, or at least to the community, has essentially been passed down, but it all comes down to patience, really. And that patience is really thin from what I've seen in the community, and there's a lot of fatigue that I understand. But I also understand the point of view of people who are new to investing. Well, it is actually torture for these people because investing, you got to prepare yourself. It may take months, years, or so on, depending on your trade. So, a squeeze is just a technicality. It's not essential to down to fundamentals because we already know that the hedge funds or market makers, they don't care about settlement dates. It's all about the algorithms, right? They don't care about investor sentiments. It's just demand and supply based on their levels. So I'm talking about level trees, right? And funding accounts are just like credit cards, right? The way I say that they don't care about settlement dates is just that funding accounts are just like credit cards. They just sell debts to one another and resetting the cycle of whenever they have to pay their debt obligations, right? So I've been saying for months now, market makers, they give you credits through the brokerage platforms you use. They give you credits, right? So whenever um, because all the shares you own are actually owned by Seed and Company, right? You guys already know this. And considering that the real shares are located somewhere under DTCC, you guys only own credit, right? And that credit is issued by market makers whenever their supplies are running low. But eventually they would have to buy these to balance out their books. But considering that they always change accounts, kill funds, create funds like credit cards. Well, obviously, they get to decide whenever they get the cover, but that's also based on their inventory and risk exposure to the markets. So there's nothing that would force them to cover. That's impossible because we are literally in the hands of a market maker, but considering that we have the advantage because we have bought so much credits, eventually it's just going to take time for them to cover through the algorithm. So that's why we have leg runs between months, right? So the cycles could last for months or years, depending on that. But that's the game, how it's built. You may not agree with that, but that's how the system is currently built, right? So there's this side of the community that wants to squeeze to happen. I understand that. But the system is built by the institutions and we have to play by their rules. But we can fit their rules to our advantage and have, well, essentially our money, right? So there's nothing much that we could do unless that you want to advocate for a better system, but asking for changes takes a lot of commitment, but also a systemic change to happen. Well, it takes also a lot of money and influence and power into the political scene. So we're fighting a lot on all fronts, right? But it takes time. So you're into investing, you're not into gambling. So, yeah.
Yeah, I totally agree. I mean, I was actually having a conversation with somebody at work today, which is a little, I don't want to say dangerous, but just interesting in that context. And I was trying to explain this whole GME saga because she had heard of it, read a little bit, in January, and hasn't heard too much about it lately. Understands that that's partly a function of the media, and their limited coverage of it, for good reason. But I was just trying to explain, a few of the concepts about market structure and settlement and brokers holding shares in street name and a failed to deliver and what that is. And I said at one point, I said it's all hidden in the options chain, and she just kind of laughed at me. And she's like, "Well, I believe you, but I don't know what that means." Um, it's interesting because I mean these, you know, even even those of us that have been in the market for a long time, which obviously Kringle, like you have much more formal chops than I do. But I mean, I've been investing for quite a while. But one of the things that I find really interesting about everything that's happened this year is the push to understand market structure and the research that a lot of people have kind of collectively done to um, uncover a little bit of what's going on. And it's probably just the tip of the iceberg. That I think the broad community probably has a very basic understanding of what's going on, with some people digging deep in certain areas and coming back together on it. But there's just a lot of different aspects of this. Like, it goes really deep. I mean, I could definitely pick your brain on a lot of different concepts, but I don't know. I feel like there's things that we've probably covered multiple times, right? In terms of settlement, in terms of fed to delivers, in terms of synthetic shorts and options, or even direct
Right.
registration. But yeah, it's
To me, it's fascinating because people blame a lot of the hedge funds, which I kind of agree. Like, I agree the sentiment. But there's this side of me, right? I work for them, essentially, because I'm a hedgy, right? But also want a better market structure because it doesn't make sense at this day and age, right? Because we're all competing against level 3s and 4 because they are the higher levels of the order books, right? And people criticizing, well, in fairness, that's true. In fairness, that against hedge funds, right? But hedge funds also trade at level 2, right? We get to see all the orders that are in the market, like you guys. So we pay for those services at level 2 to get access to those books, right? But also you have the opportunity to pay also for those services to see what I see, right? So there's nothing that in from my world that we're hiding from you, right? Unless that, yes, hedge funds are, they're dealing with billions of dollars. They may or may not have access to, insider trading information or whatnot, but that's just money, right? But you guys also have the same opportunity because you get to have theoretically the same, level 2 opportunities to see the orders on the market. But whenever we compete against a market maker, right, level 3 orders, well, that's all about supply and inventory, right? So they get to create markets, but they get also to destroy markets. And also they have the ability to destroy publicly traded funding accounts. That means ETFs or 13F filings that hedge funds actually file periodically to the SEC. And whenever they see a weakness in some of those hedge fund accounts, well, they get to destroy that account for them to create liquidity on their side. So our biggest enemy is not you retail for hedge funds, but actually market makers, because they get to see our positions and destroy them. So we are not worried about retail, at least at level 2 hedge funds, right? The market makers, well, they get to see our orders, so that's where we're scared of them. But in some leverage positions that they have taken in, like GME or AMC, it could be Clove or BlackBerry, SNDO, whatever securities that you are investing right now, right? We already know, right, based on the movements of the stocks, on the volume, well, we know well, as a gut feeling that their supply or inventory is low, basically because everything has been bought up. And what they have been doing with the brokers, well, they're just issuing credit, and they would have to buy credit from you. So that's the technicality behind the squeeze, essentially, because they would have to cover the books at some point in the future. They get to decide when, but that's based on their risk exposure to the markets, on their credit system, right? So whenever they're shorting positions or the way on how credit is built, well, eventually they would have to buy back those, in order to not bleed out, right? That's it. And it may take months, it may take years, but that's the same, not story, but this is the same thesis that I've been giving out for months. And I get that people want change, but changes happen in the political scene in Congress. Well, they do not understand us, let's say, right? So just imagine people not understanding in Congress about social media or how crypto actually works. Well, there's a generational gap and lack of understanding about those concepts. And pro- there's a problem of status quo in Congress because the old ways. Well, when I'm talking about the old ways, we're talking about the stock market. The stock market has been around for hundreds of years, right? Of course, it has some evolutionary steps because we're learning every cycle. There's a crash, right? We're learning from those crash to create better systems, right? But the shit always gets kicked the can down the road for so many times to a point that they understand risk whenever something bad happens. And whenever something bad happens, changes happen, right? For now, for Congress, they don't see the danger. So they don't believe that the market crash is coming, right? But you know that the Fed is lying to you based on their, financial positions and whatnot. But all they can do is delay the inevitable, right? They're just kicking the can based on their treasury and whatnot. There's a lot of problems with on the outside of the economy right now, right? We have a supply chain problem, right? The Congress cannot keep up with the expenses, and they want to regulate things, right? They want to regulate crypto because crypto is kind of interesting, right? The side of crypto, I understand why the SEC wants to regulate that sector, not because they don't understand it, because Gary Gensler at the helm of the SEC, well, he knows about cryptocurrency, right? And he's afraid about the huge leverage of crypto because it's let's see about the APY rates, right? The APY rates on, let's say, on a USDC coin or USDT coin, right? Stable coins, the average APY returns on a stable coin is 8 to 14% based on the platform that you're staking your coins on your stable coins. But for the average return nationally on your savings account, right? I'm talking about a banking regular savings account is 0.05%. And you know that 8 to 14% is not normal for a return on a stable coin. So people are just naturally, well, why keep the money in a banking system which gives me a 0.05% return on the stablecoin on savings account? Why not go to crypto? So crypto has this idea of this limitless loaning, right? And loaning has been a disaster for 2008, and they don't want a repeat of 2008 uh, on the version of crypto. So that's why they want to regulate it as ASAP before the house of cards actually crumbles, right? But also the stock market is highly leveraged because people are in the last, I'd say, since COVID. Well, at least when the lockdown happened, well, people were actually investing like drunken sailors with their stimulus checks, right? And that's how leverage is built because considering that we have seen the interest rates for so low, that gives the opportunity for the brokers or the banks to loan even more, and they got greedy, and that's why we see the SP 500 to be hitting the all-time highs, new records all the time, with the crypto having those incredible, let's say, pump and dumps, right? Because we're not having a cash problem anymore. We have a lot of cash in the institutions, in the banks, right? It's not about cash, it's about collateral, right? There's a lack of liquidity and a misusage of collateral because when you borrow something, eventually you would have to pay back, right? But people were keep delaying those settlements infinitely because they use the excuse of COVID or whatnot to delay the inevitable. And of course, those interest rates, well, they keep piling up, and you see the danger, right? So that's how the house of cards have been forming over time.
Kringle, if I may, is this the reason why you refused to pay me back the $100 I loaned you like 6 months ago? Because
Oh no, because I sold the debt to someone else, so you have to deal with that guy, and the settlement dates just reset.
oh, okay, it's that new bespoke tranche. So that $100 has been divided 1,000 different ways, and now I have to go collect from 1,000 different people. Cool. Okay, sorry.
Yeah,
You may
yeah,
continue now.
that's fair. Right, that's fair. So that's not my problem anymore.
Apparently not, but
Yeah.
I'm just going to write that off as bad debt at this point. Thank you for that.
Well, hey, thank you for writing it off because I have puts on your debt. So
Of course you do. CitadelAir is doing
cha-ching.
just fine. Thank you very much. Our
So
my
all of that monologue that I've been doing, right, all this time, it's not about AMC and GME anymore. It's not. It's about the whole fucking economy going to shit, right? But you guys get to see it. But in the outside world, at least in the real world, whenever you go back to work or you're dealing with your family, they're oblivious about it, right? But I'm telling you guys, the economy is sick, right? But it's just the can being kicked down the road. So whenever the market crash happens by the end of this year or next year, who cares? It's going to be bigger than 2008 for sure. But the question is when and how to become prepared before the said event happens, right? That might scare you, right? But use this beautiful opportunity of insane bullish market, right? Of course, you're gonna get see traps like pump and dumps. That's normal. Well, that's not normal. That's just fucking market makers creating liquidity and for them to save themselves and delay some of the stuff. But you can ride the waves on some of those securities, right? Like a big lesson that we could take out from this, right? About the Trump stocks, right? So, Trump actually advertised that, he was creating some kind of social media platform like Twitter based on a SPAC, right? But understand that Trump has millions of followers, and we could consider them like some part of that following could be cults, right? So they are hardcore followers of Trump. So you may use that sentiment based on purely speculation that millions of dollars would be investing into those kind of speculated stocks for you to ride the waves and of course make a profit. It could be like a 20, 30%, 40% scalp, right? But it's not about shorting, it's about people's sentiment about speculation, right? And market makers, they get to see that opportunity to raise bids because they get to spoof bids, right? They get to raise bids and decrease bids to create a fake sell-off of a said security. But you can ride waves to make a profit on a trade, let's say 20, 30% scalp, and practice this. You can paper trade. some of those securities to practice yourself to not only anticipate but understand people's sentiment over securities whenever they pop off, right? Because by the time you see on the news like, oh, this security has popped up like more than 5,000% in a day, right? It's already too late to invest. They're gonna pump it, they're gonna dump it for sure. It's already too late. Those who have been participating in DWAC or what's it called? Was it Mark?
Mark, or was it Fund, the derivative, one of the derivative companies, or those
Yes.
correlations?
So they saw those securities running, right? And that hit the news. Well, by the time you see the news, it's already too late to make your investment because retail don't drive this, unfortunately. Institutions do. Institutions, they get to see the real shares because they get to see an investment bank and they issue real shares, right? But on the side of retail, you're only buying credit. And whenever a credit, well, you don't buy a real share. It's like a derivative is a share, but that's just debt, right? And AMC or GME or whatever company that you're investing in, they don't even know you as an investor. You don't have even your name in their ledgers because obviously you need to hold a real share, right? And wait, you say, wait a minute, Kringle, how come do I have a fake share? No, you have a credit, right? But it's not registered in your name, it's registered in the broker's name, right? Unfortunately, uh, whenever you want a real share, you would have to register that share under the name and you don't want your brokers, right? I'm not saying that people should DRS, right? Because people are saying on social media, oh, I should, register my shares to lock up the float. But there's a danger to that. I always explain two sides of the coin. I always explain two sides of the coin whenever you guys want um, to own a share, right? When you want to really own a share, you're basically extracting funds away from the DTCC. Essentially, the DTCC is giving the certificate away from them to you, right? Um, so you could be dealing with, computer share because they're a company that actually deals with brokers and they want to get the certificates away from the DTCC. That's how they register their shares essentially, and they want to put your name on that certificate to make sure that AMC or GME recognizes you as a real shareholder in their ledgers, right? But whenever you pull away a certificate or a real share away from the DTCC, right, you're pulling away liquidity from the markets, right? But if people remove liquidity away from the markets, why? Well, that actually validates or remove liquidity away from the indexes on where the security is located, right? So right now the AMC or GME could be located in the SP 500 or the Dow or the Dow Jones or the Nasdaq, whatever index they are, but once they are removed from the index, right? Unfortunately, they are not listed anymore on those indexes, and that will create fear, extreme fear, or whatnot for an extreme sell of the markets. And considering that market makers they cannot, create or destroy markets, well, that's just based on supply and demand going directly from retail. But it's going to get delisted. The stock's going to get delisted away from the markets because we pull away liquidity. So essentially, you're not going to see any tickers on Yahoo Finance or whatnot because it's delisted. So there's this danger about locking up the float or whatnot. but I don't want to go into technicalities. But institutions, they do register their shares with the investment banks, right? Of course, that's their job, right? Because they may they have a fee. If you're dealing with a broker, of course they have to get the shares, right? If they're in investment banks and AMC or GME wants to issue new shares, they have to deal with investment banks. And investment banks, well, they deal with the lit exchanges along with the market makers to promote some of their stocks to have cash raised for the company, right? But if we pull liquidity away from the markets, well, that's equally as bad. But you always see two sides of the coin, so you get to decide what is best for you, as long that you make more than 7 or 8% per year. Because as long as you make more inflation, well, you get to win essentially.
Yeah. No, I mean that's really interesting because I mean I've definitely heard both sides of that argument, like in terms of direct registration and like the potential effects, like you said, that it could have on liquidity and even potential delisting. I mean, I wonder if that is a certainty. I definitely understand what you mean in terms of the various indexes and the way that the market makers can kind of create or searching for the right word, but basically take apart like a share of a particular ETF to create liquidity that way or to, you know, take positions that way. And I know there's been some others, you know, prominent names like Dave Flower for one, that has mentioned like the delisting risk as it relates to direct registration. So it's interesting. I mean, on one hand, I wonder if that would be the worst thing in the world because then it becomes more like private equity, right? I mean, not really, but
yeah, it's hard to say because people want to encourage, you know, registering their share, which is not wrong, but as long that people are not, you know, somehow, you know, recommending, you know, registering their shares, because that's literally financial advice. But we get to see two sides of the coin. Either you want to register your shares to lock up the float at the risk of potentially having the stock delisted and getting investigated because people are massively, you know, registering their shares. But you know, I get to see the interest in that, right? But people do what they want to do, what feels best for them, and I encourage that, right? And that's it.
yeah. Well, so I think part of what you said, going back a little bit to just some of the just very, you know, rampant speculation in the market and, you know, what could happen over the next, you know, call it 6 to 9 months, even though it's not a specific time frame. Like one of the things that CitadelAir and I were talking about a couple of weeks ago, and you know, I just kind of came to a realization. I'd like to get your take on it a little bit, but essentially, I switched jobs recently. Right, I had a 401k that I'd been investing in for a long period of time, and you know, after I left this company, I decided essentially I need to roll it into an IRA.
That was a horrible company you worked for, Halister, too, right? Like absolutely.
It was awful. We're not going to talk about them. We're not going to call them out by name. I don't want to do any of that. But
my father would be very displeased. But I just want to make sure we're on the same page.
We are. But anyway, so as I started that process, I'd been following the market, you know, pretty closely, and I mean, I was already somewhat concerned about, you know, a downturn in the market, which, you know, we did see a little bit of a downturn for about 45 days, right, mid-September, you know, through, well, actually maybe not part of October. There's a good 45-day little downturn there in the broad market, but just a blip, really. Anyhow, like I came to the realization that in my 401k, right, I have a bucket of things that I can theoretically invest in. And some of them are more aggressive. Some of them are, S&P type mutual funds, or some of them may be bond funds or total market funds, or even like these target date things that are, actively managed and have high fees, and you could really recreate the same thing yourself relatively easily just using other funds with lower expense ratios. But the realization I came to is that I couldn't sell. In my 401k, it's you set an allocation percentage, and all of your contributions and investment income is essentially allocated based on certain percentages into the funds you choose. But there is no sell button. If I wanted to keep my 401k in cash, I was not able to do that. Obviously, in an IRA, like if you're self-managing an IRA, you can sit there and you can hold it all in cash, or you can buy options, or you can sell options, or you can, invest in direct stocks or indexes or pretty much whatever you want to. But I just felt like maybe it was something I knew the entire time under the surface, that I didn't have the ability to have my 401k sitting in cash, but it kind of bothered me when I saw it directly, and I wondered if it's something that everybody knows. And I was just somewhat interested in your thoughts on that, because if you think about the way things have changed over the years, for better or worse, a lot of people used to have pensions through their employers. It would take a while to get vested, and those liabilities are sitting on the company's balance sheet. So you've got a concentration of risk in terms of, the company managing those investments appropriately to be able to pay you out. But, 401ks have been pretty prevalent now for, I don't know, at least 20, 30 years. But when I was thinking about it, I kind of came up with the concept of what I would call just lame money, because it's not that it's smart money or dumb money or anything else. It's just you truly have an inability to sell.
And the origin story of why we have 401ks, right, Halister, versus or what they were designed to what they're designed for.
Well, it's supposed to be supplemental income in retirement.
Yeah, in short, but it was designed to relieve businesses or corporations of their need to provide a pension.
Right. Yeah.
So they were no longer carried pensions, and they said, you know what, y'all, we'll throw some money in your 401k, but you're on your own for retirement. We're not going to be on the hook for your pension, because that doesn't really go well sometimes when your life expectancy gets cranked up, and et cetera, et cetera. So.
Well, yeah. It can also, from a company's perspective, it could, I'm not going to say it bankrupted companies, but it certainly hurt their balance sheets like significantly. And I think in some cases it did, right? Like poorly managed pensions really hurt some otherwise good companies, right? Because maybe managing an investment portfolio wasn't their core competency. But yeah, it's interesting. I've heard a lot of stories kind of on both sides in terms of the 401k versus the pension. And I know some people have gotten burned, pretty badly by pensions, but I don't know. I just, that realization for me was kind of a big one, that, if you have a certain sentiment about the market, you can rotate into, safer investments. You could rotate into bond funds. But if you're worried about, country's debt, along with rampant speculation, you're kind of just SOL, and your money's just tied up at the mercy of the markets, so to say.
I don't have many experience dealing with pension funds, because obviously hedge funds, we deal with accredited funds, right? So we're somehow in a bigger game, but also we're dealing a lot more leverage, because we deal a lot more with speculations on the markets per se, because we don't operate in the norms of what a public traded account would do, right? And so yes, in some cases we do some YOLO trades, right? Based on the numbers we see that are feel safe for us, and that we could, YOLO some of the securities. But for a public traded accounts, right? So whenever you want, because institutions over the years, based on the cycle they're currently in, they could be irresponsible, right? And the ways on how they have been loaning their money to people, and the leverage that they're building up. But also they're fucking up some of the pensions if they are careless, right? And of course, whenever you're dealing with self-managed accounts, so self-managed accounts are essentially you're giving at the mercy of the brokers to manage your funds. So it could be some bonds allocations, some real estate allocations, or gold allocations, depending on your risk exposures or based on your settings, right? So you have certain risks, so you set your risk to low, medium to high, and they get to execute based on what you have set those settings to your preferences. There's not much power that you can do over control of your pensions funds, but that's how economic cycles. So if you're approaching retirement, and that that the current leverage of the institutions are really really high, and the economy is doing bad, well, you may have some concerns, right? Because you're years away from retirement, you do not know when a market crash happens, so you don't want to blow your funds or your pensions. That's a normal sentiment, but unfortunately, we can't predict a market crash. It's impossible. It just happens when it happens,
Yeah.
right?
Well,
For
real quick, I guess I was just thinking more. I mean, maybe not so much along the pension, but with the 401k thing, just the fact that you can't hold it in cash, like if you don't want to, and that you're
Right.
forced to be invested, it just, to me, it kind of reiterated that concept that retail is always holding the bag, or in this case, not
Right.
even retail, because you're not actively investing. I mean, this is just passive, saving that is at this point conventional wisdom, and you're essentially forced to hold the bag. Like you can't go
Yeah.
short. You can't hedge your positions. You can't do any of those things because those funds aren't offered. It's I mean, to me, it's systemic in a way, because as long as people are contributing to their 401ks, which is conventional wisdom, and which is, I will say what I continue to do, but there's always going to be an inflow of money into the market, like as long as that is the status quo. And the folks that have their money tied up there are always going to be left holding the bag in some sense, because the smart money is going to react quicker to a turn.
There in my years of trading, right? I've always followed the flow, essentially the whales. So whenever I see a whale putting some heavy money on some securities, that's where I'm more willing to come in to invest and follow the wave, right? And in order to do that, in order to mitigate some of the risk, I like to create accounts. So accounts, you may spread those accounts between different institutions, but whenever you're dealing with accounts, why institutions want to create accounts? They want to create um, a safety nets, right? So accounts are like safety nets, and they are covered by insurance. And per account, per federal regulations, I believe it can be covered with 250,000 max per account, right? But you guys get to do the same, right? And whenever you're a client under a brokerage, right? You're a client, you're a customer, right? You are entitled to certain services, right? And in order to mitigate more of the risk that you're taking because your accounts are actually covered by more insurance money, right? But also get to see that you also have access to some research reports done by institutions. And it could be research reports from Bank of America or Merrill Lynch. It could be Fidelity. It could be National Bank of Canada, right? Who cares? But those research reports have their place in the markets because you get to see their plans or the futures per se in the next quarters or so, and you get to see which sector could be more beneficial for you to trade based, not only based on speculation, but based on fundamentals, because those research reports are actually done by those institutions because they are willing to invest in those securities in the future at some point in the next quarters. Let's say they say that, oh, we think that, let's say that 4 or 4/5 of the institutions are saying that, for example, that Tesla could be having some corrections, or at least the tech sector could have some corrections by the next quarter, right? And they're looking into financial, they're looking into financial or consumer staples, right? Well, those are the sectors that they are willing to rotate in to create pumps, and that's where money is being flowed in the next quarter. So that's where you can prepare yourselves a bit more, because those banks, they are willing to invest in those securities or in those sectors because of the reports they have been given to their customers. So in a sense, I've seen the reports from Bank of America. I've seen the reports from Vanguard and BlackRock, right? And those are, public traded documents given to their clients based on their services, and they all say that on average that the tech sector will be performing more or so, but the financial sectors and the energy sectors would be doing relatively well in the next 2 quarters at least. So you get to see the interest of those institutions where they are willing to pile in their money for the next 2 quarters, and for you to prepare which security would be interesting for you, because based on common sense, right? Why energy sector? Well, of course, electric cars are, exciting and whatnot, but those are long terms. When we're talking about 2 quarters, what happens in the next 2 quarters? Well, obviously the winter season, right? And people consume more energy, and more money is being flowed into the energy sectors. And that's why banking institutions, they want to pile in money, because people are being irresponsible, or they want to shelve themselves into consuming more energy to protect them from the cold, right? That makes sense. It's all about interests of institutions, and you make those connections, right? And eventually you'll get to practice more, and you're going to feel more safe with those securities. But that's all guesswork. That's a lot of guesswork, but also you got to work based on supply and demand, right? So more demand is put into the energy, and of course supply has to be given, and of course more money is being flowed into the energy sector. So that's why in the next 2 quarters, obviously energy sector would be doing naturally well for at least the North American and North European countries for an energy sector. That could be used as an example, right? But that's how money is being transitions between institutions and the markets. But you get to decide what feels best for you. It's all about supply and demand, essentially. It's all about mitigating risk and how you get to exploit the opportunities. And of course, some of the services you need to have access, well, you need to get paid, right? But you know you do what you need to do, essentially.
Yeah, definitely. No, I mean, I love following it and looking at, yeah, sector rotations and things like that. I mean, I feel like this year I've seen a lot of these things, but I may have hit them just a little bit late, like on, semiconductors, for instance, earlier, and then, even with shipping and, some of the other things that we're still continuing to see run right now, like they're still going, but I really wish I'd gotten into some of these things a little bit earlier. But
Yeah, the shipping problem. If you buy things on Black Friday, there's a real possibility that you won't get your items by Christmas. Especially, they conduct those sales on Black Friday because Black Friday is essentially like a holiday in United States, right? But considering that there's a lack of supply going on, you're not guaranteed to have those things that you have purchased online to get delivered to you on time by Christmas. So there's this danger, but that's how it is.
That's 100% accurate. The my wife's or my mother-in-law moved down from New England to Florida, and she brought some furniture down, but she thought she'd buy some new furniture when she was down there, and went to a large furniture store that had a large showroom, and uh, you know, um, and bought furniture, paid a fair amount of money, scheduled delivery. They said, yeah, a couple weeks. She moved the beginning of August, like first week of August, let's say, and she has no furniture except for what was trucked down there from New England. Everything she ordered, they keep telling her 2 weeks, 2 weeks, 2 weeks. Now it's looking to be like December is what the new ETA is um, on like basic fundamental furniture. So it is alarming to say the least. And you make a valid point. With the Black Friday or whatever the Amazon equivalent is, if it's not in stock, I may be hesitant to pull the trigger on certain items.
I mean, if you don't believe there's a problem in the supply chain, understand why your PS5 or your Xbox hasn't arrived yet.
Exactly.
right.
Everything's fine. There was a quick question I got from one of the listeners. They were asking in general, like what the fees are assessed by who's ever your plan administrator or your fund administrator for your 401k. And the most recent data I think I found was from a CAP study circa 2014, saying that they found that if you started saving in your 401k at the age of 25, the average worker in the U.S. In the median salary range at the age of 25, making nominal contributions. Over the course of a lifetime, they were showing that that person would be paying out almost $139,000 in 401k plan administration fees. On average, they were finding more current 2020 study didn't break it out that far, but they were showing that the average American with a 401k, the average fee was about 2.25%. Or expense, with plan expenses. It ranged anywhere from I think like half a point up to 5%. But the average was almost like 2.25, which is something to note. Look at your statements. I know most people are paperless, and a lot of places, in my opinion, banks and other credit card companies and your investment portfolio want you to be green and do electronic statements. At least look at those. Don't throw away the ones that come in the mail. Otherwise, you're going to be shocked. And check the fine print, because let's think about it. If you started saving at the age of 25 and you're in the median salary range of most Americans, $139,000 is a lot of money. I don't care who you are. That's a lot of money.
Yeah, absolutely. I mean, it's one of those things. I mean, with the 401k, you're kind of you're with what your company selects, essentially. I mean, you can, in most cases, you're getting some kind of match from the employer. So that is, free money on top of it. I mean, there are other, tax-free investment vehicles that you could invest into otherwise, right? Like a regular IRA, a tax or a Roth IRA, so which obviously, like, you get to select the broker there. And I mean, there are some that have, very low cost, funds that you're able to put in there. Plus you may have a management fee if you want them to manage it for you, or you can just self-direct everything. And then obviously you're not paying a management fee, but yeah, that's significant. I mean, reading statements, that was a conversation, I was having the other day, and I don't remember if you jumped in on this one or not, but I think it was about just checking statements, or even like auto pay. I don't auto pay my cable bill or my electric bill or any other bill for that matter, because, while it's super convenient, it is nice to be at least tapped on the shoulder to look at it every now and then, because you never know really what's going to happen.
Yeah, no, that was our conversation, and I was griping on my my Comcast bill skyrocketed, and then I went to go renegotiate it, and for the next 2-year term, whatever, and they were not willing to do anything. Pretty much, they were like, "Well, if you switch to paperless, we'll give you $10 off, and if you switch to auto pay, which they would just hit my American Express arbitrarily every month, ad infinitum, and it will give you another $10 a month. So I'd save $20 a month if I didn't get a paper statement. Okay, I kind of get that. But then if I'm on auto pay, the bill's already paid. I can still dispute if there's a problem, but I'm not. Chances are I'm not going to be keeping tabs on the increase. And the only reason I saw I was tracking the small increase, but this was a huge whopping increase. The only reason I caught it was because I'm old school. I still use checks, so. Yeah, they come out of, I have a check printer. I don't actually handwrite the checks, but it's faster, based on like my situation and how I manage funds. But I know exactly, with a certain margin of error, like where every dollar goes. I'm not going to say penny, but I'm aware of when Verizon like slaps something or slides something under the radar, an extra $5 a month here or there, and if it's worth my time, I'll call it out. But the notion of, auto pay and paperless, if you're careless, or not paying attention. What I was trying to underscore with the 401ks was that, sometimes you can get away with, sometimes you have no control until you leave that employer. You can roll it over. Other times you do have options where you can do self-directed, as mentioned, and you can choose the funds. But just be cognizant that those funds may have management fees or expense fees, administrative fees, as well as the plan administrator on top of that. I could speak endlessly about this, and if people are actually interested, I can, get my eldest brother. He's a CPA who does nothing but specializes in 401k audits. So he sees it day in, day out, and also sees some corrupt practices by plan administrators. But that's a whole other subject.
Wow, I bet he gets all kinds of busy seasons doing all the 401k audits, huh?
Oh, no, it's a constant business season between 401k audits and then, or assurance, and then does, corporate, he has like 500 clients just for corporate tax filings,
Wow.
which also means they're his clients' personal tax filings because of the K-1s, etc. So it's a perpetual busy season.
Yeah, it's interesting though. I know we're talking a little bit. We're not talking as much about individual stocks or different things tonight, but I think this is important stuff, for everyone to know. And it's one of those things. I remember being told a long time ago, and I think it's good advice. And if you are like looking at funds in a 401k, obviously not financial advice, but one of the most important things you can look at is the expense ratio on the funds, because the difference between various investment managers often aren't all that good or aren't all that great, right? There's not that big of a divergence. If something has an expense ratio of, 0.05 and something else has an expense ratio of 1%, I doubt that 1% is outperforming the 0.05 all that much year after year after year. But
agreed. I see that David has graced us with his presence as well.
Graced is such a strong word.
I was wondering, you were muted, so I didn't know if you were snoring or not.
I was here listening.
If you were, I was hoping that you'd unmute, and then we could just like all fade out to the snoring of David.
That's the roll credits sound. Is that what it is now?
The roll credits, and then I'll wake you up with the hot pockets.
Hot pockets. No, it's all good. How are you guys?
I am well, sir. Happy Monday. Welcome in.
I caught the tail end of this call. It sounded interesting. I appreciate you guys spreading information. That's what it's all about.
Indeed. You missed my opening diatribe monologue, and so did a couple folks on YouTube about due to a tech issue, that an oversight on my part, but you probably would have been snoring if you were listening. So it's probably good you did. But thanks for popping in, amigo.
You paint me to be like a narcoleptic.
No, you're just an insomniac, and when you do crash, you crash hard.
Yeah, no doubt. No doubt. It's true. I agree with that.
What's on your mind, brother?
Nada. No, I've been just trying to get ready for tomorrow, and today was a good day, so no complaints.
I can't complain either. Not to have a complete sidebar conversation in front of everyone, but I know you tweeted out the thing tomorrow, but did Alex circle back with you?
Not as of yet.
Okay, I'll check in with DL and I'll ping him.
Very cool. I appreciate it.
Anyway, I'm sorry. Didn't mean to interrupt. If anyone has questions, feel free to throw the hands up and come on up and ask away.
certainly someone has something, or like a little change of pace. Otherwise, it might be wrap it up time, guys.
Yeah, it might be. I mean, unless is this when I plug Kringle's online dating profile? Is that what we agreed on?
Wait, what?
I thought that you were like enjoyed long walks on the beach. You're an Aries.
Cats don't like water.
I know, but he's the exception. He's just looking for love in all the wrong places, like Twitter Spaces. So I agreed to help him out, and helped him on his Bumble profile. And I didn't know if we were plugging it or not. We discussed it before the call, but I don't know.
The trick I find to getting people to want to come up and request to speak and ask questions is try to do something fun, like the Mandela effect stuff. And the second you start to get into it, 400 people will come up with DD questions. It's like this guy Murphy, he's got these laws, and that's how it goes.
That guy Murphy, he follows me around like I never see him, but that cloud,
he's just everywhere.
Dude, everywhere I go. Matt C just popped up.
Hey, what's up, man? I ain't got much. Just want to know if the short's covered.
Does anyone know? I wasn't really super tuned into the market. Did the shorts cover today? Anyone know?
I don't know. For most of the country, it's too cold for shorts. Oh, you meant like in the market? I thought you meant like they cover the knees or something. No, they haven't covered that. Not to my understanding, anyway. Not financial advice. Do your own due diligence. Trust, verify. Make decisions you're comfortable with. Hot pockets.
In full disclosure, I do hold some short positions, and I can assure you that I have not covered. What I am shorting, though, is irrelevant. It's nothing within our community. It's just something for sport. But in full disclosure, I have not covered my short position.
You realize that half the people in this room, the hair on the back of their neck just stood up with the first half of that sentence, right?
I know they did. I know they did. That's part of my. I won't say what it is because it's polarized. It's politically polarizing. So it's not. I can tell you, it's not AMC. It's not GME. I have long positions. Have had for a very long time on both. It's just I thought it would be. Did some quick analysis and I was like, this will be fun. So I picked up a significant short position on something, and I have not covered. I do not intend to cover anytime soon, even though it's gone the other way. But it will recover, and I will notify everyone once that has occurred.
I'm guessing what you shorted is trading in the low 60s.
That would be accurate, sir.
I'm so smart. I impress myself every once in a while. Either that or I get lucky. Either way, I'll take it.
No, you must know me well. Or I was that obvious. But no, that. It is trading. It is trading in that range, my friend. Yes, indeed. I'm happy to watch it come down every single day.
You know what happens when you put a hot pocket in the microwave too long?
Oh god, I haven't had hot pockets since high school. I don't know.
Who just did that? Who just did the microwave sound?
No, in all honesty, that was my pager going off.
No,
I'm sorry.
That needs to be a soundtrack now. Every time I say hot pocket, somebody needs to have like a microwave beep go off because that was just awesome.
Yeah, that was legitimately my pager. I mean, there's. I'm not even on call, and well, I'm not. It's not important. I can call them back. So, well, I guess that just kind of disclosed my career to everyone. Sorry.
They paid you for fires, like to respond to the fire department?
Yeah, 100%, sure. I've got an axe under my seat right now. I got a jet.
You know, never mind. I was gonna make such a bad joke. I'm gonna behave. Anyway.
Yeah, you get me fired before Kenna comes back. So, yeah,
had nothing to do with that. It was just no.
There's much speculation on our YouTube channel as to what I've shorted. Sorry.
I was going to make a point, and then we got distracted. Oh no, just the fact that was like perfect comedic timing of the beeps.
But I was surprised it wasn't you paging me, to be frank. But yeah,
if I thought of it,
next time. If you get my pager number, I'm seriously going to be creeped out. I'll be honest.
The equation.
Dear.
Great babe.
What's up, Grape?
Good evening, gentlemen and ladies in the audience. I had a question. If we are, I guess it goes either way. I have both AMC and GME, but if we are such a large block of shareholders, how can, it seems like everything as retail, everything is basically a secret from us as far as Wall Street goes. How come we can't force a independent, I mean, everything's electronic. The stockbrokers, the hedge funds, the banks, they know every single share at the end of the day at settlement at 4:00, forget whatever after hours and all that. But by the end of the day, they have a very specific number, which is probably never wrong because, the numbers in your account are what the numbers are. How come we don't have any power to request an independent survey at the close of business on a Friday to count every single share in, and have, how do I say this? Have every broker report a number of how many shares they're holding for their customers and send it to a central accounting agency that's not necessarily connected to the SEC because they're shady as shit too, like an accounting firm, and just have them turn in the numbers of what they own of a certain stock so we can get a real number of what's actually in circulation.
Yeah, I mean, it's a good question. I don't know if...
I thought we were going to talk about Mandela effect. No, but you see how that worked? The second we even mentioned Mandela effect, people had good questions. Just wanted to point that out.
Well, I had the question for 20 minutes, so you didn't butterfly me.
I mean, it's a good question. I don't know if Kringle's still around. I mean, he could speak to it a little bit, but I mean, to your point, I don't know that any individual entity necessarily has all that information. And I mean, part of the reason is because of T+2 settlement. There's, all the brokers and the market makers. I mean, they take orders. They some would say it's the price that we pay for liquidity in the market. A lot of those orders are internalized. A lot of times they'll make the transaction, regardless of whether they've located a share, like on the buy side or the sell side. I mean, they have exemptions to do that. Does the DTCC ultimately get all that information right a couple of days later, like on settlement? And are there failure to delivers and all those kind of things? Like, yes. I mean, I don't know. I was in accounting for a while, and I still kind of am in an accounting related thing. I mean, like the practical answer to the question, which is probably not what you want to hear, but it's just effort and cost.
Well, I guess my point being, it doesn't matter if it's a failure to deliver. I don't give a shit if E-Trade or whoever sells me stock failures to deliver my brokerage account. It says 500 shares of whatever. I own 500. It doesn't matter if they show up or not. So I'm saying, like, on a Saturday at midnight or Sunday at 6 a.m. after all the numbers have been crunched, whatever the numbers in everyone's account says that they own is the count. It doesn't matter if they're FTDs or not. You still bought the shares and they count as a share. So why cannot, if you asked Fidelity at Sunday at 6 a.m. and the market's been closed for 36 hours, say how many shares are in your customers' accounts of GME? Give us one number and turn it in. And then they do that for every single fund, and I don't know what broker.
For every brokerage.
Yeah, every brokerage firm and everyone in Europe and everyone in Canada and everybody in Korea, and just say, send us a number. How many shares are you holding? It doesn't have to be broken down by account, just what's their total amount of shares. And they have that number. I'm sure they could pick that up in 5 minutes.
So the first question is, when you say they ask for the number and each brokerage sends it to them, who's the them in the question? I'm trying to understand. I understand your question, but I'm trying to flesh it out.
Like one of the an accounting firm that can't be corrupted. You have 3 eyes verifying everything that comes in, and everybody's going to have the same answer. And then you open the envelope at the end of the day and it says there's 5 billion shares, and everybody's like, okay, holy shit.
So the entity that would be requesting that information would have to have the authority to request that information, right? So it's not like you can do it or I can do it or anybody can do it individually. It would have to be an entity that's empowered or authorized to request that information. Basically, and I don't think there is an entity that can do that without there being some other precipitating cause to do that. So here's my point. I think what you're getting towards, and I think a solution or something that's in alignment with what you're trying to achieve would be a share recall, which would achieve what you're trying to kind of flesh out. But that's not something there's only certain circumstances and certain entities that can initiate a share recall, is the point.
Well, if there's 80% of the shareholders that want a share recount and we're his boss, don't they have to do it? Can't we bring that up in a investor annual meeting and say, listen, we control you. We are the company. Recall the shares.
So I'm gonna.
But you have to own the shares first. You own credit. You don't own the real shares. You don't even have your name registered in that ledger of said company. So AMC or GME, they don't recognize you as a real shareholder because that share is registered into your broker's company, right? So it is up to the brokers to recall the shares because they own the shares.
Well, I mean, okay, I'm not saying I don't believe you, but I'm like, I've had shares in Berkshire Hathaway and I would get a letter saying, "Hey, you're a shareholder. Come to our annual meeting. Here's all the details."
Who did you get the letter from? Your broker, right?
I don't remember. I mean,
So
I wasn't gonna
right.
go.
Right.
Yeah, because your shares you're dealing at street level. Your brokers are representing you, but you still have the voting power of said shares. But your brokers, they literally have their names on that certificate, right? Not your name, but they have fiduciary responsibility to represent you based on your said vote, right? And in order to get a real share, well, essentially you would have to register your shares. It's up to the investment bank or whenever you want to register your shares, like computer shares, although it is up to you whenever you want to register that share, right? But that being said, delegating that power to another institutions, because I can say that a lot of shady shits are happening. It could be Vanguard, it could be BlackRock, it could be Citadels, or it could be whatever, right? For me, it's all part of the same pie. They're all institutions. They have all their own agendas. They do whatever they want to do to secure more money on their side. The thing is, in order to delegate that much power, it requires Congress approval. And the SEC, right? They want to ban, let's say, the order flows of, the payment for order flows. But that bill is still, it has passed the financial committee, the House of Financial Committee, but it has yet reached the House of Representatives on top of the Senate, because those decisions for the SEC to enact such investigation or for that action to ban those payment for order flow system away from the market structure, right? Well, we need bipartisan support. And obviously, the Republicans obviously won't agree to that, but Democrats, right, they are willing for a fairness of market structure and blah, 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 but that's part of their political agenda, right? But all we have been doing is pushing for a fair market structure, but it has yet reached the eyes of Congress with bipartisan support. And that's why we are talking about lobbying people, right, in order to represent us in Congress. But we're fighting against bigger sharks than us. We're talking about billions, if not trillions of dollars worth of investment into Congress because they have already people in place and we're just pawns into that game, right? And that bill that we are looking for is for the, I believe it's 4617, 4618, and 4619 under the 177 Congress. Those bills are for retail in order to for the SEC to conduct an investigation to ban payment for order flows. The second one is to enact harsher punishment for market makers or institutions to front run the markets. Front run should be illegal, but there should be a harsher punishment, at least with years of imprisonment, right? That's on the agenda. That's the bill that they have been written. It has yet passed under the eyes of the president. And there's a third bill I don't remember what's the purpose of it, but I believe that's also for power retail. But for the time being, it's all good on paper or talk by Gary Gensler that they're looking to market structure. They want to improve things, but they cannot do shit without Congress approving. That's how it is.
Well,
it's all about lobbying markets. That's all about lobbying politicians. There's this fight against BlackRock, right? From mining companies. From a credit union representing miners, right? The coal miners, and they have been fighting BlackRock for so many years, and they have been lobbying firms in order to represent them, and that requires like millions of dollars for that firm to, as a retainer, to represent them in Congress. But have been fighting BlackRock for years, and Congress is not even listening, right? So imagine we're millions of people. We're barely like maybe a few, maybe let's say generous hundreds of thousands on Twitter fighting for market structure fairness. But there needs to be a collaborative effort to be made in order for Congress to listen to us. But they listen to institutions, but because they get to pay more, lobbyists. And lobbying is legal, unfortunately. We have to deal with money in order to fight money. Well, obviously, we need to have money as a movement or business or organization, however you can call it, in order to influence those people who are fucking with us.
Well, at this point, Alexa off. God damn. At this point, I don't even think Congress could get together to raise a $5 fine on a jaywalking ticket. So I have zero faith in our government at this point. And, you know, after the next 5 months or whatever, however long it takes for this AMC, GME thing to go down, and I don't know. I'm kind of done with all of it and just going to crypto, and that's probably what they're most worried about. I mean, the government is basically bankrupt, even though they can just keep printing money. So I see inflation coming. I don't see anything. I don't see any good things coming to the future of trading with the world and our own government bankruptcy and all the housing defaults and all the corruption. I mean, it's like everywhere you look, the whole country is basically just based on corruption at this point. And I think their biggest fear is all of us just moving to crypto and not even using the dollar anymore.
Yeah, but crypto's got its own issues because it's even less regulated, so there's even more.
Yeah, I mean, I
played there.
I understand that. So, but
and I would argue that more regulation is not exactly going to actually, my opinion, but I don't see more regulation having any kind of effect on how it fundamentally is working. I mean, Kringle, I don't know if you guys have crypto in your portfolio, but if you do, you might know the answer to this question, but maybe you can refresh all of us. What is the leverage ratio on crypto generally?
100 to 1.
Oh, yeah.
100 to 1, yeah.
That's my point exactly. So, I mean,
they play the game even harder there.
Yeah, which is why we see these huge pumps and swings soon as the bell rings at 4:30 Friday, and then by pre-market Monday, you see the swing the other way, generally speaking. But just my observations.
All the regulation in the world without enforcement and then subsequently appropriate or adequate, I guess is really the right word, adequate punishment is meaningless. So there's 3 layers to the onion. First, you have to pass the law, then you have to enforce the law, and then the laws have to have teeth. So we're in my opinion pretty early on in that 3-step process on a lot of fronts. But we're certainly, I think, have drawn, or we certainly have I think have drawn more attention than a year ago. So I mean, we're definitely taking a step in the right direction, but I think a lot of people would rather see a brisk walk at least, as opposed to just a couple of steps, let alone a jog.
I've seen the day trader. I've seen videos of the day traders. Like I'm a buy and hold guy, and I'll sell it if I can, whatever. But I've seen the videos of the funny videos of the day traders that are on massive leverage on Bitcoin or whatever, and then it goes down 5,000 or whatever, and their account gets wiped out. It goes to zero, and they're like throw their computer across the room. Who's the entities that are allowing this massive leverage? Because this would be one thing in crypto that I would want the regulation. I want to get rid of the leverage. It's always the leverage people and the short sellers. And I mean, there's a point of short selling might be good in a situation, but it seems like it's 90% bad and leverage is bad. And who's allowing all this leverage on crypto? Like, is it a platform?
It's the lack of regulation.
Yeah, but okay. I mean, I'm not a crypto genius. I just use Coinbase and whatever, and I buy and I hold and whatever. So what platform's allowing these kind of leverages? I mean, does anybody, just a general question.
It's up to the platform's responsibility to mitigate their risk and willing to take that risk into account in order to loan, because you get to loan crypto and also use crypto as a form of collateral in order to receive money to pay your said bills, right? But that's how the market is built, and how it's up to the, because crypto is still new, the platforms, they get to say whatever they want, essentially, because of the lack of regulations and also because of what they're allowed to do. For me, crypto is like the Wild West that is trading like 24/7, right? The institutions, they get to play the same game that we do, right? They get to increase the bids, they get to pull out the bids, whatever. The amount of fuckery that could happen in crypto is on 24/7, while the stock markets, well, it's always to 9 to 4, right? Or 9:30 to 4, depending on where you're locating. But that's essentially it. It's just the lack of regulations and how crypto is still new to the markets, essentially.
Right, but I would argue that they have the same access we do, more or less. But there's a couple issues with that, hurdles. But I mean, we all don't have supercomputers with algorithms and that can do high frequency crypto trading either. Not all of us are
Right.
the CringleKitten that can like execute 1 million trades a second, while sipping Cavassier at 1 a.m. in the morning.
1 a.m. in the morning is repetitive.
If you're talking to crypto style, we're not in the crypto game, but
I was just joking. But
I know.
It's and especially there are some platforms where especially it's like the PFOF model. They're not charging you to trade. There's no fees to trade crypto, but the bid ask spread is ridiculous. I'm not trying to say anything negative about Weeble, but I'll cite that as an example. Like you have to buy you can bid, but I mean, you have to basically, if you want to buy, you have to buy at the ask, and and the spread is not in your favor. You're already starting off at in an unfavorable position. IBKR, which I use now, started supporting crypto trading, I think it was like a month ago. And because it's commission based, I mean, you can do your limit orders. You can buy at the price you specify, not regardless of what the spread is. But if that makes sense, forgive me, I'm starting to fade a little bit, so I may not be as eloquent as I wish to be.
Oh, also the gas fees that you're taking account based on the Ethereum base coins, also you have to pay for those. So of course you're not trading any fees, said platforms, but the gas fees could be expensive, and if you're on the wrong side of the trade, well, that's too bad.
100%, and that's something. Even though I do dabble in crypto, that's something I often often forget about until after the fact. So valid point. David, you have your hand raised, it appears. What's up, brother?
So two things. One is, when it comes to leverage, it's kind of all comes back to even how the bank works. There's leverage just in a deposit, right? So the whole banking industry is set up upon leverage, and it just extrapolates all the way through. The other thing I want to mention is it was just mentioned that let me just see if he's still up here. Great, babe. Just for clarification, do you feel that your question with regards to doing a share recall, or somehow getting a response to your question regarding how to tally the shares, was somehow not answered, or that Kringle and or I went off on a diatribe regarding that?
No, I mean, you said what you know. I mean, I just think that when there's so many shareholders, I know you said, oh, we're just the brokers are the shareholders and we're just the scum of the earth, but
well, no, that's not what he said. He said that because of how it works when shares are in street name.
No, I get it.
Yeah, we're not the ones that have the ability directly to go to the company, because as far as the company is concerned, the brokerage owns the shares. They don't see our name unless you do direct registration. But the point being is that the entities, and when I said this, the entities that would have to request that would be, in essence, either the SEC or the company itself.
Well, then we need to maybe go to the CEO of the companies that we own and say, listen, put this on the proxy vote of the next shareholder meeting. We want to vote on a share recall. And there's 5 million of us, and we want it on the menu.
So let's flesh this. Let's flesh this out, if we could, for a second. What would be the benefit of that? Your mindset is, hey, if we can prove there's X amount of billion shares potentially, right? Not financial advice, to your own due diligence, but if that's the hypothesis, and we proved it out, that would somehow relate to pressure for those positions to be closed? Question mark. Is that what you're asking?
Yeah, pretty much.
So, but the problem is, it probably wouldn't, in my opinion. Again, nobody knows, because this is kind of uncharted territory to a large extent. But my personal understanding, and from what I've seen and learned and heard, and my understanding, I'll just call it that, is that it would potentially derail something like that, because it might actually cause such an investigation to go where things could actually go really not in that favor. We'll say. We'll leave it at that. Do you see that as a possibility?
Okay, but on just on another question along that line, can you explain the actual share recall? Let's say a company just said, we want to do a share recall. We think there's some shit going on. In a share recall, do all shorts have to close or not?
I don't know the answer to that question, but B, yeah, we want
to recall the shares and reissue the shares to the shareholders. So we need all the shares back, and then we'll put a serial number on every share, or they're going to NFT every share, or whatever. Or they're going to move to, let's say GameStop says, we want out of this bullshit DTC whatever, and on the New York Stock Exchange, we're going to open up our own exchange that only sells GameStop, and everybody's able to participate, but every share will be an NFT, and everyone will have a serial number on it, and their shares can't go missing, because when you buy a share, it gets traded just like a crypto would.
Is there anybody up here that's more familiar than I? Because that's not hard. I'm not very familiar with it at all, or I'm not.
Yeah, what he's referring to is the CAT system, the Consolidated Audit Trail system that is being implemented. So we're in the beginning stages of such implementation, where different securities and futures are having some kind of serial numbers attached to them, where we could get some more transparency on reporting such securities to the SEC, right? And this has been in the project for nearly a decade.
Right. Well, I guess the CAD system will only work on things that happen from that day forward, right? It doesn't go back retroactively.
Exactly.
So his question I guess I'll make it my question. Are you familiar with a share recall, like the mechanism and how it would unfold, and whether or not it would precipitate shares to cover their short positions?
It does not force people to cover their shares. Like I said, the market makers, they don't fucking care. They don't fucking care, because all of the shares are based on a credit system, right? All the shares that you own, the real shares, are actually owned by seed and company, right? They hold the certificates. They hold because they work for the DTCC. They are, let's say, a benefactor or a company that works for the DTCC per se, and they hold a certificate, right, on behalf of the brokerage. And the brokerage, they deal with, some kind of swapping system between certificates, because they have to loan them, right? Because loaning is their business model, right, for the brokers. And that said, when the brokers, right, not the brokers, the market makers, like I said, whenever people's sentiment wants to create a market based on their demand. And when demand is astronomically high, like AMC or GME or BlackBerry, whatever, right? Well, considering that there are no more shares available, well, what they have been doing is creating synthetics or debt obligations, right? Shorting to retail, but that's illegal. That's legal. Level 3, that's legal, right? That's called naked shorting, or whatever, how you call it. It's legal for them on level 3, but on level 2, that's illegal for us, right? So they get that advantage to create that credit-based system because you, as retail, want to buy more, while institutions, they are forced to short more and to give you credit. And based on their risk management, at some time in the future, they would have to cover that debt obligations and balance out their books. But the real share out there has already been sold. But that debt obligation still entitles you the same voting power or so to that company, right? That's it. That's why whenever you participate in the shareholders meeting, you have your shareholders that have registered their shares, right? And the others, well, obviously, the brokers, whenever they hold that certificate or that share for you on your behalf, well, they get to vote as proxies, right? That's how it is, right? It's all they have been doing are mostly legal, but they are doing also shady shit, but we don't get to see that because we're not on level 3. That's it. I don't get to see those books. I don't get to see those numbers, right? But I do get to see or anticipate based on their supplies or inventory that market makers had in order to make my guess on trades that could potentially have benefits into the markets. But I don't get to see level 3 or level 4's order books. That's off access to us. And if you're asking transparency about the amount of credit that is given by the system, you're essentially asking information from level 3 and level 4. That's not going to happen.
Yeah, I mean, big picture, it's unfortunate. I mean, I hear your sentiment, like, in a lot of what you're asking, and I mean, it definitely feels like that, could be the answer, or should be the answer, and I don't think any of us up here are advocating for it. It's just kind of the way it is, and I mean, from my understanding, I mean, I'm not 100% certain, but I also think that for a share recall, there are certain conditions that have to be met. I don't think if, in your example, like Adam Aaron, if he wanted to just do a share recall tomorrow because that's what the shareholders wanted, I don't think that is necessarily within his power as the CEO. I think certain conditions have to be met. Some type of issue needs to be raised to him by the transfer agent that issues the shares to drive that, again, for better or worse.
Like, apparently I owe some money to Citadel, right? But I told him that I sold the debt to someone else. Well, he has to deal with him. That's, and considering that the debt is, considering that Citadel owns the shares, he has a loan money to me, right? But if he does the recall of that share or send money, right? Well, I'm not entitled to refund him that money. It's up to the guy that I sold my debt to, right? It's essentially the same thing, but that debt that is being bought either from a market maker or from those in the ISDA contracts on level 4, they have somewhat the privilege to delay the settlement dates indefinitely based on their risk management, right? Like I said, creating accounts out of the blue whenever it's like a credit card, right? And swapping funds or shares between accounts like credit cards, you get to essentially reset the clock of said settlement dates. That's how they cheat the system, but that's legal. And you may call this unfair, but you can call that unfairness to Congress and propose a bill to make that change happen whenever you want transparency and you want to have some level 3 information that should be downgraded to level 2 in order for you guys to have that same information and to have some, more fair playing field. But now we're not even there yet, and I don't believe that Congress is willing to make that change.
Hi, sorry, I got a question. Can I ask something?
Yeah, go ahead.
So, the mechanics, how I understand it, according to your explaining, basically you have all the shares that are actually on the possession of City and Co, right? And then everybody else go and issue a debt on those. So they actually don't own the shares per se, but they share a debt on those. Are those is that share in form of cash?
Yeah, essentially, yeah.
So they don't actually have to retrieve the shares like per se. They need to just give back the cash, right? So that will give them that possibility. Now, the share recall, as you say, and then it doesn't make sense just to recall the shares because they will just give back the cash or have being able to just get in more debt and then just keep pushing more debt as long as they kind of actually sustain it, right? Now, is there any other mechanic to actually keep that debt in form of shares? Because if City and Co doesn't have it anymore, doesn't have those shares anymore, and they will be in DRS, does that mean that debt has no collateral? Like it literally has no the other side of the debt is not there. So how do you manage to not, for example, in the situation that GameStop managed to, I don't know, take over the company from the DTCC and create their own marketplace? What would they try to do in that situation? What would happen? Are they actually forced to close those books, or they just want to keep that debt in there and return it in money at some point?
They can keep that debt there indefinitely. That's based on their risk management, right? They get to decide whenever to cover that credit or debt that they have issued to the markets in order to balance the books and to make sure that the shares are in the markets are, let's say, 500 million for AMC, right? It's all about balancing her books, and that's all about balancing credit. In order to force recall or share, you have to own that share. That's where the idea of the DRS system comes in by the community. But there's this danger whenever you own the shares, because you own the certificate, you pull away liquidity away from the DTCC, and also you're pulling away liquidity away from the index for that stock to be potentially delisted. So that's why I've been explaining that there's always a double-edged sword whenever you're dealing with securities. There's always some kind of fuckery that you have been, being cautious whenever you want. Whenever I deal with institutions, right, or the Fed, or some impending news about some security, the institutions, they like to trade around the fuckery, right? They deal with the bullshit or around the bullshit. And that's how the system is built, and changes happen over time. Well, they take a lot of time, years even, or they may not happen at all, because that's not the interest of Congress. For things to happen concretely and to have fairness of market structure, you need to have bipartisan support of Congress. So that means that Democrats and Republicans, they have to be united on said subject for bills to be approved. But what's happening with the debt ceiling, and whenever we're talking about education or whatnot, or regulation or crypto, it's always a fucking pissing contest between those two parties because they don't listen to each other. It's just about agendas and political power, right? But that's the game that is played in Washington, and there's not much leverage that we could do to pull away the power in Congress, right, in the political scene. But for that share to be recalled, I mean, that's why it's up to people to decide whenever they want to DRS their shares in order to force a recall. But that's really up to them.
So I got
right?
I got another point, pretty much. So the mechanics of it is the actual debt behind it. So they don't really need to give up the actual shares, but the risk management is going to be on an amount of that debt. Now that would explain why raising the actual price of the share, it will be increase that risk in form of that they will be owning more, because well, they obviously own is the amount of shares, not an actual set amount of money. Now that increases, right? But yes, let's say that that will increase, and until the actual let's say Citadel, or let's say a hedge fund can actually sustain that risk according to how big, or how the size of their own business compared to the size of the debt. But when that happens, and let's say they get margin call, the margin call escalates to the person above, which is going to be, well, I don't know, the market maker or the actual DTCC itself, right? So they will also have their authority to say, like, well, you know what, I'm going to margin call for X amount that you don't have. But as proven with Robinhood, they can just at any point say, like, oh, you know what, never mind, I'm just gonna give you more credit, and after that I just regulate to create a higher ceiling on how much risk you can handle. So in that situation, or what happened pretty much with Citadel, like giving money to Robinhood, someone else can absorb that blow, or kind of buy that debt, and they just keep like rotating that around. So in that case, right, is as big as the DTCC itself, pretty much. How much they can hold that bubble. Now, if and that why also that marketplace and a blockchain makes so much sense. Like I've been studying this for like the last maybe 3 or 4 months. It makes so much sense, but the question, it could be either like that could be kind of like the best situation we will have, or like the best chance we will have to take the shares there and create a new market, which is going to be decentralized. But is the DTCC, well, through the government, because well, pretty much they are the government, able to influence on that decentralized market, maybe with legislation, you reckon?
Well, I foresee that more regulations is coming in, but the amount of leverage on crypto, the stocks, right? The stocks, they can deal with synthetics or debt obligations, however you call them, or naked shorts, or however you call them, right? It's mostly legal most of the time, right? I cannot be certain that there are illegal shit that are done. I'm sure there is, but in crypto space, right, on how the credit system is built, the credit system is built on the collateral itself, because you need to own the same crypto to be used as collateral whenever you want to loan money, right? You need to own that security. But for stocks, you don't need to own those if you're on level 3 or level 4. So that's the main difference, right? And how the market structure is built on crypto, I can understand why leverage is higher on crypto, because it is a necessity for the borrower to present a collateral, which is the crypto itself, right? As for as for stocks, well, stocks are different because the credit is issued by level 3 and level 4, and they don't need that inventory available for them to short to retail. So that's the main difference there.
But that's what I don't really like enjoy about these markets, because this leverage, especially on the derivatives, this leverage, it will create not just a temporary but also an ongoing like little bubbles everywhere, because that leverage will be you betting on possible gains of a bubble where you're actually having bet, but then you keep those bets in there, and that though the rest, let's say you use 10 times leverage, like a multiply 10 times, I don't know, and then you grab those 10 times doesn't really exist because you're putting just a bet. Yes, you could lose this 10 times, but you could also win those 10 times. So in reality, you are creating that possibility of like, hey, I'm going to inflate this one 10 times, but it just doesn't seem well in a way that these hedge funds, these central banks, these market makers not just have those loopholes, like for example being able to um, naked short or rehypothecate over, I don't know, 100% or 110%, which is like that's supposed to be the obvious, right? But being able to go over that, they would just create bubbles over bubbles. Now, I was checking a table the other day in which the actual table shows how much assets the world usually like have if you put everything together, which is amounts a little bit less than 500 trillion, right? But they calculate the low end, the mid end, and the high end of the actual derivatives markets, like swaps, options, blah blah blah, and you amount the lower end to like 750 trillion, which is already 250 trillion higher than what exists, right? And the high end was in a quadrillion. So this makes me realize this is just a massive bubble in the whole thing through that leverage. So which seems to be as a necessity hasn't been controlled at all, and right now is the actual cancer in my what I see, like in my opinion. What do you think that is going to happen with that? Like all that leverage, like it is not going to disappear, right? Like it's just a bubble right there.
Well, we are in an all everything bubble at this point. Because the leverage needs to get paid at some point, but that's up to the banks, right? So the hedge funds, the market makers are not the least of my concerns, right? Yes, of course there are fuckeries happening on those levels, but people need to watch the banks, because the banks, they have one of the largest leverage out there holding for their customers, and that's how retail could get fucked, because we have been talking about the 401ks, their savings, their life savings and whatnot. But I would watch the banks, right? And what's coming, it may happen during the Biden administration or the next presidency, but the crash won't be pretty, because the amount of leverage that we have built since the COVID lockdowns have been astronomical, right? I believe that there are some institutions that are aware of it, that the SEC is looking into the leverage, and they have been. I'm sure there are steps taken to make sure that to deleverage some of the risk. But I believe that the Biden administration is willing to taper the markets somewhere this month. Although I'm not so sure, because the Fed, well, they always lie to us.
But there is
you don't say.
Yeah. Sorry about that. So there is a big concern, because yes, like you said, I believe 100% that if the debt is there, obviously the weight is carried on the banks, especially on the central banks. So I did that research about like 6 months ago, because I was very concerned, especially not with inflation. Like obviously Burry was like alerting about hyperinflation, all that. But I knew that they were going to do as much as they could to hide it, changing formula, changing everything, so people don't enter in panic and kind of like just keep printing because they love this quantitative easing. But now, from while back, so the actual Federal Reserve as we know it right now was born in 1987, right? And I check on the board of directors. I got a list of the board of directors. This is all money. This come from Rockefeller, like in the 1900s behind, right? This come from old money. But then it goes to these banks, and go a little bit to the 2000, right? The dot-com bubble. Then they removed the Glass-Steagall Act, right? They allowed merging the actual um, low risk well, investments, which were the mortgages, which, like, the solid investments, with the high risk yields, were the stocks, the securities, right? Mixing those two, it creates just that big network of everything on, like, interconnected, which is highly risky. Now, happens 2008, everything blow out. 700 billion were roughly the bailout distributed to these banks. They just pay huge bonuses, blah blah blah. Now, from there, they bailed them out in 2015, but that bailout was already like 1.5 trillion. That's already double. Now, since 2000, before March, when they got bailed out, because basically on March the economy was about to collapse, so like it went really bad, and they just need to, like, emergency inject pretty much money. Now, the big concern I got with the banks, since I've been looking, is the way they've been manipulating LIBOR for so long. Now, on 2019, in around October, November, I remember they were looking at changing, or starting to change, the LIBOR to SOFR, right? SOFR, yeah. They were changing that, and they started realizing that the actual banks didn't have enough like balance sheet, or like sheets, really, the books to change that, because they've been, during the entire pandemic and before, manipulating those rates, like, you're supposed to, higher those rates if inflation is high, so people stop, borrowing money and taking money from the banks. But instead, they just keep it low, and each bank were kind of just like self-regulated, doing whatever they wanted, and that created all these massive amount of loans. I'm not talking about just commercial loans. I'm talking about personal loans, mortgages, um, these loans with very manipulated interest rates. Now, when they are going to change to SOFR, which they stopped it from the pandemic, that's supposed to happen in 2019. They did those stress tests that these idiots have been doing, that doesn't actually work. And the economy was about to crash. Then they stop it. No, we can't do it. Then the pandemic starts, and now they're delaying it almost 2 years. It's coming now in December. I think that might be a massive blow for the actual banks, because they're not in a good shape right now, and that's probably the reason why they're manipulating all those loans for such a long time. Now they can't manipulate LIBOR anymore. They need to stick with the treasury yields. What do you think that's going to be the impact through the banks? Because that affects straight away to the DTCC, and that could be the ultimate catalyst to make them pay their debt. Like, if the bank is struggling, it's going to go and try to collect their debts, right? That's pretty much what they straight away going to do, right?
I'm not sure what happens with the banks, but we know that the banks are largely irresponsible on how they have been loaning money over the years. But I believe that Citadel has more information regarding to that. I can't recall which bank has the highest amount of leverage. I believe that's Bank of America or Citigroup or Morgan Stanley, between those three. But I'm not
There
so
is a
sure
lot of
anymore.
people also throwing water to Wells Fargo. I think they just want to put
Yeah.
most of the leverage on them and then just like make them fold sometimes. Like they just want a scapegoat, right?
There's always a scapegoat on Wall Street to figure out which is who. Well, we don't really know.
Right, but the point being is to try to put all the negative eggs in one basket and then let that one basket fall is probably a pretty sound strategy on their behalf.
So basically doing DRS is not that doesn't work. It's like that doesn't actually force them unless, I don't know, somehow we can take the entire company out of the DTCC, right?
Yeah, the recalls just don't work because you have to own the shares, and considering that the market makers, well, they get to decide whatever to cover based on their risk exposure to the markets. Well, there's not much power that we could do because we're not dealing at level 3 and 4. So for them to, that's why I said for the longest time, AMC, based on the inventory of market makers, well, I get to see that AMC and GME, based on the cycle theory and whatnot, and the algorithm and how the stocks have been moving, they would squeeze like Tesla. It's not something that is gonna do like 5,000 or 6,000% gain on the day. That's not how it works. It's all about supply, demand, and risk management done on level 3 and 4. And the algorithm, they don't care about investor sentiment. They care about the liquidity that needs to be raised for the next leg run of said stocks based on supply and demand. And they don't care about settlement dates. I already said
So
that.
you think it's just gonna keep legging up over time, like
Yeah.
Tesla? But now, do you think if there was a market correction or some extraneous large event that kind of put into question liquidity across the market, you don't think that would potentially relate or result in a spike-ish or a spike-esque squeeze?
Based on the algorithm that we have been analyzing at my firm, right? We see that there are at least 2 more leg runs on AMC, and beyond that, we don't have enough analytical data to support that thesis yet. But 2 more leg runs on AMC so far. GME, we're not working on GME for the time being. And we do see a market correction by Q2 next year. So that's the amount of information that we have
That's
currently.
as much forecasting
and
as you
beyond
have.
that, it's not. We are not
Right.
sure.
I think the cyclical aspect of it makes sense. I just think that, you know, as it legs up potentially, it just exacerbates any type of effect that a market wide issue would have on it. You know, obviously, the bigger the number and with leverage, the more dramatic the resulting liquidity issue would become. You know, pretty quickly.
And also, market makers and hedge funds, they are smart. They always manages risk. They always hedges themselves. Either it could be from the derivatives, it could be the options or whatnot, but they create more leverage to solve leverage, which is a kind of a vicious circle, but that's how they have been
I
doing.
just got a question from somebody. What about the effect of DTCC B15997-21?
The what?
DTCC B15997-21.
I don't recall that rule. Maybe just a quick synopsis, please.
I don't know it. Minimum 25% haircut. No, I don't know if that's the. That's
How
the
about
new.
that?
Yeah, the new one.
That's
haircut.
the one. That's the 1st of November rule coming yesterday.
Right. So what do we think? I guess what about that? What effect do you think that'll have?
For now, it's just kicking the can down the road. It's not gonna affect pretty much anything. I don't think it's gonna solve anything at AMC or GME levels.
I think that if something catastrophic,
I don't think it concerns us for the time being.
Well, I'm actually sitting in front of the document presently.
Yep. And Doug was the one that asked the question.
And it's supposed to be effect end of business today. And basically what it is a document to all participants regarding settlement from DTC Risk Management. On October 25th is the document's date. And it states beginning October 29th, 2021 for settlement date November 1st, 2021. DTC will implement the following changes to modify the collateral value for certain securities, which may affect the value of positions applied to the collateral monitor. Number one, U.S. state agencies and GSE securities that are not rated or rated AAA, AA2, AAA to AA will receive a haircut ranging between 5 to 35%. Those rated below AA2 or AA will receive a 100% haircut. Supranational bonds rated AAA, blah, 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 will receive a haircut of 20%. And most securities with no active market prices for 3 consecutive days will receive a 100% haircut. And then as you scroll down into the document, it states that, let me get back to it because I was there and I left it to read the heading. Money markets. Here we go. Equity securities, common preferred listed on a U.S. national securities exchange, NASDAQ, or a Canadian securities exchange with a market price of $10 or more per share or per other unit, they will receive a 25% haircut. With a market price between $7.50 and $9.99 per share, they'll get a 30% haircut. With a market price between $5 and $7.49, it'll be a 50% haircut. And with a market price below $5 per share, it'll be a 100% haircut. And this is as per B1 5997-21 from the DTCC.
Doug, I just stepped away. I missed that. Can you read it again?
What, the document?
I'm kidding. I'm joking.
No, well, hey, look, man. I mean, it's important to know that this is out there and how it's exactly affecting things just based on its on their value.
I think at the bare minimum, it shows, well, 2 things. It shows that there's a concern for liquidity, right? Because they're trying to avoid a problem or mitigate a problem before it's full in effect, in my opinion. And then secondly, it really comes to the point where, you know, if we're talking about what could be a catalyst, what could potentially, like, again, market correction seems to be, you know, top of mind for most people. So if it's a squeeze and it's from 2 different sides, one is the liquidity and 2 is the value, well, that changes the liquidity.
Well, and that's the reason I brought it up, because even with the algorithms running the patterns that predictably they've been running, they're not accounting for things like this to take place. I mean, this is a huge change in margin requirement.
That'll be in the algorithm before it's in effect. There's not a doubt.
One thing, I think these terms with liquidity is not much to actually force anybody to do anything. Is more like to show they're trying to do something, but in reality they kind of have like almost unlimited ways to keep it rolling. Like it's not like they're gonna do all these haircuts. Like, I think many people have seen the actual market as little corporations, right? And they all have like their own little margins, right? But as we can see now, if those corporations blow up, someone else will gonna absorb the blow. So it comes to the point that at the end of the day, the biggest or just the DTCC itself will absorb the blow. So all these haircuts and everything is just to moving one money from one side of that market to another side, but it's never getting out of that market. So in reality, it's just that's just kind of like a smoke and mirrors, in my opinion.
Yes and no, because here's the thing. So, like, I'm big on analogies, and here's a good one I just thought of. Imagine
I'm going to step down and give you somebody else space. Thanks for letting me up.
No problem. Imagine you're trying to pop a water balloon. Yes, there's, the water balloon, to your point, is never really full to the point where just a little push is going to pop it. There's always plenty of elasticity left in how the whole mechanism is designed, and this one picks up the slack for that one. And if that one fails, this one eats it. And yes, there's all of that there, but at the same time, if 25% or some percent, depending on the value of the security, just goes away, that makes the water balloon or the size of the balloon, the latex itself, that much smaller. And then if you have some type of a market-wide correction that increases the volume of the water in the balloon, that makes the whole situation stretch that much thinner. I don't see how it's non-consequential. I get what you're saying, that there's a lot of place for that to be absorbed, and it's just kind of like, pushing it from this side to that side, but you're never going to get it to pop.
All right, let me put it a little bit better with your analogy of the balloon, right? This balloon is not that is growing to the point that that the inflating or getting full of water to the point that is almost about to pop. No, really, these people might have the actual possibility and the actual they have to show capability to keep growing that balloon, to keep adding latex, because they literally have direct connection with the feds. Like the banks are in there telling them like, hey dude, DTCC, how much money you need, just let me know, I'll give you more. And they will quantitative easing, they will adjust it, they will just produce it somewhere else. As we can see, and I told you the derivatives market is in 1 quintillion, right? It means that they just been inflating, no problem. There's like double the amount of things that double more of the things that already exist in debt. So they will just keep going. They have no, you can do 3 times, 4 times. Why would they have a limit of how much they can give to the DTCC in terms of debt?
So in the last 8 months, the repo market essentially doubled, right? From a half to a whole. You don't think
there you go, 1.5 trillion.
Right. You don't think at some point that's like, all right, 2 trillion, we're done, we're out, that's it. You think it just goes 2.5, 3, 3.5, 4?
Well, they say that they have like 80 billion per participant. So they keep just spreading through different participants and throwing the ball here and there. Or at the end of the day, they could just go to the point and say like, oh, you know what? We are raising it from 80 billion to 200, 500. See, it's just numbers for them. So what would you think they're gonna cap it if they can just change the regulation at ease?
I don't think it keeps going up that high. That's just, I don't know.
But then,
I don't know the answer. I have to think at some point they got to be like, look, this is just the house of cards has to fall. That's it. They have no choice.
Oh, but that's not gonna be of how much they actually get in debt or leverage themselves, because they don't care. They will let the world burn if they can steal more. So they're just gonna keep living it, and keep growing that debt until the whole economy collapses, pretty much. Because this is what is happening. That debt is not collateral, but actually services, products, items, the actual economy.
Right.
And that's what is the bigger problem with quantitative easing.
I think, to your point, if they have their way, absolutely they would keep doing that. But I think at some point, some entity, mainly the government, has got to say, if not is already saying, this is, we're not comfortable with this situation going any further, or you have this much more rope, but that's it.
But now the other problem rises, that the government is right now being held hostage by those same banks and DTCC. Why? Because this government is so soaked to the neck on debt, right? That to right now make a decision, the actual, you think that the president and the Congress have the power to make decisions and blah, blah, blah. But in reality, they need to ask permission to the Treasury before they spend any cent. So whoever has the actual say is Treasury, Feds, and the banks, ultimately. So they actually have the decision making. That is the actual problem, that the government is being held hostage by the leverage of their debt, pretty much. And that is just going to exponentially keep growing. So it's going to only get worse if we don't stop, if the people don't stop it right now. It's really scary.
So I'll play devil's advocate. I don't disagree with you, but how? So you said it's only going to get worse if people don't stop it. So the question is how?
How is, you know where the power and people resides? The power of people, or the power really resides where the mass put their money. And the problem is that we, for so long, been persuaded that, you know, banks will have our money and store our money. We put our money there, we store, and the bank will have it. But in reality, we need to not put money on the banks. The moment that people take the money of their banks, the moment they start struggling, the moment they don't have customers, the moment they bankrupt. That, like any other business, you need people. You need the people, because the economy is the people, the products, the services. That is the real economy. That they produce bills as an IOUs for that work, for those products, for us to trade. But right now they've been printing so much more that they actually is, that currency is going to implode. That currency is not going to work. See? So I think the solution, as well, hard to do, but if people get and stop doing businesses with the banks and start using more, well, eventually, if we're going to have that marketplace, we're going to have that decentralized option. That will be the power, pretty much, where the money resides, where the actual, all the people put their trust, pretty much. That's why they care so much about trust.
Point, but to your point, if what you're saying is, like, basically, if we take our money out of the equation, in essence, take our money out of the banks, they're just going to create more anyway, wouldn't they?
That's gonna, so right now we don't have an actual other option than using fiat, pretty much. If we want to trade things on convenient ways, we don't have it. And that is what I've been investigating lately, because, for example, if you look at Bitcoin, decentralized, one of the first blockchains, created the whole technology, but has a very, very gigantic flaw. The layer 1 on Bitcoin only allows 7 transactions per minute. If you check Ethereum, 13 transactions per minute. If you check MasterCard, they do 4,000 transactions per minute. So Ethereum, Bitcoin, decentralized blockchain cannot withhold any amount of flow transactions that our world needs. We need load much more than 4,000 even, right? So we at the moment don't have any other option but using bills, money, the fiat, or the banks. We don't have any other, to trade easily, right? Now, the whole thing is about to change, because the technology Loopring is bringing with the ZK rollups, right, allows to have 400,000 transactions per minute. That is already 100 times more than MasterCard itself. That will allow us to actually use to pay food, pay petrol, pay for the movies, pay absolutely everything. Right now we can't, because layer 1 doesn't have that scalability, only 7 or 13 transactions, and too much demand. That creates what is called the gas fees to be too high, because the demand is too high for the supply. The supply is only 13 per minute or 7 per minute. That's just ridiculously slow, right? Now, with this layer 2 and with these roll-ups contracts, the scalability is going to be 400,000, but then when Ethereum 2.0 arrives, right, it's going to be almost 400,000 per shard. So it's going to have like almost an unlimited scalability that can cater the entire world. So that will be the actual solution. And that's why I've been so bullish about this, because I understand the actual potential behind this. And this is not about NFT. These have the potential to actually make a new world currency work. if that makes sense.
It does. I don't see how. Well, there's two. I mean, we're just spitballing here, so I might not have. Not I might not. I definitely don't have even close to all the answers. I don't even think I have a few answers, but I might have an answer. You still have the leverage and potential manipulation within the crypto side. Potentially more dramatically than in securities. But then you also have the aspect that this is what I would imagine would happen. I always try to put myself in my opponent's shoes. How would I play that? So if, let's say, everybody took money out of the bank, they went into crypto. Crypto is now the way to do everything, because there was a half a billion or 400,000 transactions a minute possible. So they go and jerk that around enough to the point where people get scared. They get taken out of that market, and they come back to securities. No matter how you slice it, and this is why, in my opinion, legislation, enforcement, and penalties are the only path. Is because if you don't stop the game from being played, they're going to play it wherever you try to go.
All right, but I get what you're saying, but then I think you're forgetting a little bit of different points. So now the markets are completely different. Why? Because one market in the blockchain is transparent, the other not. So it makes it a lot difficult, a lot harder to hide the bullshit, right? Yes, we've seen a lot of pump and dumps, we've seen all that, right? But mostly because the crypto market is a lot slower compared to the actual stock market. Lot smaller, like by a lot. People have that consciously that they think that crypto are big because a lot of money are in there, and a lot of people. But in reality, if you compare the two sizes, completely different. That's why they can manipulate it, those pump and dumps, so easily. But when a market cap, for example, of Ethereum gets above certain threshold, suddenly you have a heaps. You need a lot of money to manipulate it. Then suddenly you probably can't do it that easily. And the ones that can, you can track them. See, so that's up to the legislation and all to how we as a community start doing it. Why? Because the actual Ethereum blockchain works as a consensus base. See, there is no leader in there. There is no president calling the shots. This is everybody which have a stake in there. That's why they change from the proof of work to mix it with the proof of stake. And that's why the rollups work out so nicely, because they require a consensus on the chain, inside the Ethereum security. So yes, there are going to be money laundering, Ponzi schemes, like everywhere in the world, with the stock market or no stock market. That's going to have, because there are always going to be people trying to cheat, people creative to try to hack. But in this way, you can't delete the data. All the trace is going to be there. While in the stock market, they just manipulate because they self-regulate, right? So this is changing from a decentralized, from a centralized, probably mostly like dictatorship for that 0.001% or the banks, central banks really, to a decentralized, democratized market, which, yes, is going to have problems. Listen, every single thing I think in the world will have ups and downs. We need to bear with that. We need to, as a community, come with better solutions, and everybody start monitoring. But we are going to have the information, not going to be like the other market, like he's saying, we're out because layer 3, layer 4, we can't see it. Deeper than that, we can see what they do with the actual loans. But if we could see, at least we pointed out, at least we know what's going on, so people can take action as a consensus, as a blockchain. And this is going to be a game changer, man. This is going to be a game changer as long as people actually understand what is going on and start putting power into it. The volume of value not the money itself, not the numbers, but the actual real value behind the market is what is going to make that market work or not. And is has right now the same convenience and even more security than fiat.
So there's a gentleman right to your side. I don't know if he's to your side on your screen with his hand up. Fatih. He actually, we've talked about crypto a little bit. Maybe he has some insights.
I don't have any crypto advice, but I would like to get some, honestly. On the other hand, we talk about DTTC, and that's the clearinghouse when it comes to AMC. And we know already what is going on and why they don't want to pay us, honestly, because they actually took all this money and in the fate of Citadel. And right now, they consider like untouchable. They're the market maker, they in low float, and the banks, they fucking it. Like Wells Fargo, JB Morgan, you name it. Citi, all these banks, they fucking it. Raw, honestly, it's not fair because they have a license to fuck. And that's what the DTTC needs to think about it. All these investors, all these little ballers who bought AMC $2 per share, $3 per share, and they still holding it to this day. And Citadel is still nakedly holding all these shares, and the DTC is not going to say anything about it. They don't want to do anything about it because there's a big handshake going behind the door. There is big dogs hugging each other. Wolves of Wall Street. And I think that is like unfair to retail investors. You hear about Gary Gensler and all those guys.
Yeah, but that's what we're trying to do. So we're trying to see where is where we need to focus. So we see that we try to see into Citadel, and then we go up to see who is guarding or checking on Citadel, supervising it, which is DTCC, right? So the market maker are supervised by something bigger, which is the DTCC, but then the DTCC is allowed that to happen. Right? That's where you need to go higher. What is higher than the DTCC, right? So what is higher than the DTCC, in my opinion, basically, it's just those central banks. Those central banks are the ones who control the debt that they're giving to the DTCC, to all these market makers and hedge funds, right? Someone is giving them that money. Those ones are the banks, and that bank has a bigger money, which is what we call the 0.001% elite, which are the old families that some people know the names or not. I don't know if it's good to say it on these platforms, but those people are insanely powerful because they own the money, but they own also assets, right? So if you rely on the SEC, man, there are a lot higher powers than them controlling them. If you relied on Citadel, a lot higher powers. If you relied on DTCC, lot higher powers, to the point that it comes to the point that you need to check on pretty much the central banks. That's where the pretty much the cancer is, in my opinion. Now that money that they've been taking is basically part of their global Ponzi schemes, when they start just to try to scalp a little bit of conversion fees every time you send money to somewhere, or every single time you move money to one place or the other, every time they screw you with the debts or the credit cards, all these little monies in fees that is actually your money because they use your money to borrow it to another person. This is not that they're using their money. They never had money in the first place. They just supposed to store your money, and they start giving your own money, like the money for the pool of people, to everybody else. Now that they played with our money, and then they start extracting little fees over time of every transaction you make on every forex exchange, right? And then they started getting that money that they pretty much stole and playing with it and betting on the stock market, making more. When they win, happy days. We pay big bonus. We inject more money on our pockets. When we lose, then we rug it. We cover it, we pounce it around, and then we sweep it under the rug and create more debt when we lose. When we win, happy days spent, see, with the people's money. And that money is the one we are trying to claim with this short squeeze or all these mechanics. Give that money back from the banks, which is that's where the money is being funneled. I always follow that principle. Follow the money.
I wonder what Dave wanna say about it. Dave, he just being quiet.
No, I'm here. I'm listening. I was actually just talking about Thanksgiving, and I was trying to look for cheesecake recipes. I was just multitasking. Bear with me 1 second. Sorry, hold on 1 second.
Hey guys, I actually have a quick question for Friendly and Dave. I will send you the most killer cheesecake recipe that I just made.
That saves me. Everybody says their recipe is the best, but I trust you, so
I promise it is.
It's from you than the internet.
I'm known throughout my family for abusing the term cheesecake. It's been a weird fascination for like a decade and a half, and out of all the recipes, I think this is the closest to the end quote ideal. So I'll shoot it over to you.
I actually thought you were going to say you're known in your family for abusing cheesecake, and I'm like, I don't even know how that's possible.
Hey man, people can get pretty creative.
True.
So Friendly, quick question for you, man. How concerned are you personally about the subjective nature of inflationary effects from quantitative easing?
All right, I love that one. I love that one. I've been focused on that one very much because I am quite concerned. Now, quantitative easing basically is just the way, as a rundown, the way so you can actually print counterfeit money legally, right? This money, the problem with this money is that this money is not backed by economy itself, right? The collateral, the background behind this money is not services, is not items, is not new products. No, this is basically the artificial way they have to say, hey, this economy is fucked. We need to cover the holes by printing more money. Now, this, right, and I read an article not long ago, this impact, and I'm going to tell you how inflation has been growing from 2000 to 2020, so you can have a relation of roughly how the real numbers looks like instead of what percentage they show you, because they changed the formula 3 times already, and in every time they changed the formula, they excluded some articles or some industries or some items on that calculation that they were overinflated.
One interjection. That's interesting because part of that manipulation of the formula has been what I've most been fascinated with, because their argument is, and there is some merit to this, but I think they're far overstating the simplicity of it. They argue that the discretionary inflation based upon sector will have either a more or less tangible effect on the overall inflation of the market. But I don't buy it. I think in the short term that's the case, but over the long term, I don't know how they get themselves out of it.
No, the big problem you have in there is that they actually change it. You cannot just change the formulas. If you are the whole time 100 years measuring inflation one way, you can't change it. Makes every past numbers invalid. See, you're changing that, but on top of that, all right, they changed the inflation not to scare people. No problem. Now, in 2020, for an average income maker, right, a house was around $210,000 on 2000. The year 2000, average house 210,000. I got here a document. I'll share it later if you guys want, so you can see all the numbers and everything. Now, 2010, $100,000 to buy an average house in America in 2000, right? It took 3.5 times your salary, an average salary for that year, to buy a house, right? 3.5 times. Now, the banks at that moment had a cap of borrowing or giving money to buy houses and mortgages and everything of 4 times in 2000, right? So 4 times if you are in the highest spectrum of the interest. So if you have really good credit score and everything, they give you up to 4 times, right? If you will, delay on your payments or have some problems, they give you less, 3 times, 2 times, 2.5, right? In the year 2020, last year, right, houses were already over 400,000, right? And the income only, the annual income, the average income only raised from 62,000 on year 2000 to 67,000. But the houses doubled up. So now in the year 2020, just last year, to buy an average house with an average income, you needed 6 times your average income to that house, to the same house, from 3.5 to 6.5. That's almost double in 20 years.
It's
This
absolutely
is the effect
asinine.
of inflation.
And regardless of my political bent, it's so obvious how ridiculous their interpretation of the data is that it makes it pretty fucking hard to defend any of the quantitative easing. I think now the one reason I said that there's a caveat is when you're in an economic stagnation on the downturn, you do have to some extent participate in deficit spending to get out of the hole. With Keynesian economic theory, it is necessary to an extent, but continuously deflating the currency and overextending its supply with no fiat backing or any sort of anchor is going to be devastating, no matter how much they want to justify quantitative easing. It's crazy.
It's not something you can justify logically. It's something that you can keep the people dumb, because you use terms like quantitative easing, and people say and read quantitative and say like, fuck, that's out of my league, right?
Well, yeah, and the new game is they're repositioning it with more weird terminology like modern monetary theory that isn't even a theory. It's a culmination of a historical approach to the market. It's not anything new, and it tricks people into thinking there's something intuitive about this new approach that is actually any different than past deficit spending when you're in a bull market that causes systemic risk.
Well, because you're not growing the economy on the pace of your actual printing the currency. That's how it's supposed to be. So if your economy is not growing but is actually, decreasing or losing size, you should recall money, you should burn it. That's how it works. You need to keep as one-on-one the
right. They're
relation
supposed to
between currency
puppeteer.
and
Right. They're supposed to puppeteer supply and demand, and that same thing
Yes.
applies for fiat currency.
Now,
And now,
to your point, real quick, to your point about the new approach with the reality of loop ring and everything else, and the ability to have a capped amount of transactions both on Ethereum and Bitcoin. I actually was pretty deep in the weeds with that a few years ago with a project I was working on, and I noticed that same problem. But in general, I
it
do
changed a
think,
lot now.
yeah, once we've figured out a sustainable way, regardless of what iteration it is on what part of the blockchain it is, we do need to reestablish some form of anchor to fiat in a way that the gold standard used to take place of. Because if we don't, the outcome's going to be disastrous.
That is the beauty of it about blockchain, because it makes kind of like the same relation with the gold in
I
terms of
agree.
like you can one and you don't allow to create more because there is no more gold. The only way you create more money is if you inject more gold to the reserves. That's used to be like that, right? When the money used to be back on gold, you had to have that gold in your reservoir.
So this is sorry, and this is where like why I had my hand up is I'm sort of like it was really sort of Austrian economics with a gold, as a reserve. Now it's like essentially fiat economics, Keynesian economics using fiat currencies and oil. Oil is
It used to be they
oil,
changed to
I mean,
petrodollars
essentially,
to
but essentially,
Leather, I like where you're going, man. This is
but
really important.
essentially, oil is what holds up the world reserve currency, which is the U.S. dollar still. Well, I mean,
no,
and
not
now we're
anymore,
sort of, but let's continue down this rabbit hole. But let's really look at like other than the fact that it's like you can collect revenue from fiat currency. So I mean, but I think there's more to that. I think that it's like
I got
there,
all the
right?
information
You
if
can
you want to
start,
know.
you can begin to see that it's like this is the future. This is the future. It is the future as far as the next reserve is, so to speak.
All right, so let's recap a little bit on history, right? Yes, the currency started with the backing of gold, or let's start on that point. Then it moved to what we call petrodollars. So yes, based on oil and based on petrol itself. That's why also they got really political about messing with those countries they invade and all this stuff, because they wanted to negotiate in another currency, and as America don't want that because they were backed by the actual petrol. Now they changed it to fiat, and fiat is just basically based more on speculation and sentiment than actually what is reality existing, and that is just driving the market into being very, very disconnected to the fundamentals. That is the biggest problem we have. We need to stick, and not just in the currency, but in real life. People need to stick on fundamentals. People need to learn to use critical thinking to value facts over speculations and assumptions. See,
Well,
and
and
that's what
I
this
would
currency
even go as
is.
far as to say that it's like like the militaries, and I mean this is something that we should really consider. I mean, if we have Elon Musk like scolding people about like, oh, cryptos, they're encouraging people, irresponsibly using electricity in order to like whatever to mine crypto. But let's really think about like what's pushing fiat currencies forward. That's really encouraging like people to get their military like built up to basically
All right. So
essentially give their fiat currency
so let
that
me give you
credibility, so to
a lot
speak.
of let me give you a lot of insight as well. Okay, so this is basically history repeated itself. So let me explain you this very, very, very quickly. This happened already right? And we just have to go back to the 1919 Germany, right? In 1919 Germany started using that quantitative easing, started printing money, right? By the year 1920, you can check on history, you can go Google it, right? By the year 1920, Germany entered in hyperinflation, right? People needed to go with a wheelbarrow to the actual business where they were working to collect their wages with a wheelbarrow. There are a stupid amount of bills. They were already talking about billions, right? By the year 2021, you needed billions to buy a loaf of bread. I have a photo of a person actually putting at a scale. It was an actual pool full of dollars, it was German marks, I think, if I'm not mistaken, full of those bills to pay for a loaf of bread. We see the same or very close happening in Venezuela right now with the bolivars. Now, this happened already in history when they started printing, and they started in a dead spiral that they couldn't stop printing and printing and printing more and more to keep up with the interest and with the debt obligations and all that. Now, what happened that moment was every single country around it started benefit for the conversion rates, right? So every single country, France, Spain, Greece, Italy, started going to Germany, right, to buy and sack everything from it, all the economy, all the products and everything, because their currency exchange was too good. Even the people poor in France could have go to Germany and afford the most expensive cars, the most expensive meals. That completely destroyed the country.
Can I say something quickly to Leather before I forget?
1920. This happened 100 years ago. This 100 years ago. Is there in history.
Yeah. I am aware. E is probably aware, but I mean, for all the rest of our listeners, I'm sure that may be enlightening to them. I think that is important. But go ahead, E.
No, I was just gonna say, first of all, thank you for your service, man. I just saw your profile. That was my first comment. But talking about military defense spend. Go ahead. I couldn't hear you, man. Sorry.
I got a lot more if you guys want.
No, for sure. I just wanted to say something to Leather really quick. Speaking of discretionary defense spending, it's not directly related, but it's ancillary, and I think you'll resonate with this. We can come up with an endless supply of the federal budget to fund defense contractors, but we can't fund the VA adequately to take care of veterans that come back that have to experience burn pits throughout their entire career in the military. And that clearly tells me there's something disastrously wrong.
It's just basically priorities. Basically, how they're funneling the funds, and the funds they usually, or the big parts of those funds, never go where the people think they go. See, so some percentage of those funds, depends on how corrupted the project is going to be more to the actual project or less, right? But it's never 100%. That is where the problem starts. See, that corruption that they started taking cuts everywhere never stopped, because greed only grows higher. See, that is the only principle we know about, well, us humans, and sadly it's just on kind of like on nature of, if we have the possibility to take advantage and then somehow be better than others, people most likely gonna take it. Only a few, and that is coming more and more, that critical thinkers are started to see the other picture and say, like, hey, listen, I can actually benefit myself what I'm actually benefit others around me. Same way, keeping the balance. See, but so based back on the point, I want to talk a little bit more about crypto, because I think you guys would actually benefit a lot and having an advantage of knowing more about crypto, because this is going to be the future, right? We need to learn from the past to not get back to the same mistakes we've been doing, because this is all humans as you and me. We're just animals, and they made the mistakes. It doesn't tell you that is not going to happen again. See, we do as society and as animals make mistakes constantly, but we need to help each other to solve this, right? For them as well.
I just
All
want
those
to.
people that have a lot of money, believe me, they are not very happy. See, and in reality, we want us or everybody to just live in a nice place, have a nice time. Well, while we're here.
But
That's the whole
and
point.
friendly Millen, I think you're preaching to the choir to a lot of us. I mean, I think a lot of us are already early adopters and holders, the original hodlers. I mean,
whoever is not is good for them to know that as well, right? Because I don't like to assume, right? And we have like heaps of people here, so I like to take the opportunity to send those little nuggets, right? Those little messages. But anyway, so when we talk about the crypto itself, right? Where we're going, right? The beauty of the crypto is that nature of being uncorruptible in terms of like, yes, you can money launder, you can pump and dump all this stuff, but you can control it in a way that you don't or you can't produce more of it. See, that is what is going to keep the actual currency in balance. Sorry, you're going to say something? Sorry, my bad.
I just got a couple questions here in my DM, so I wanted to throw one out there. The person's still on the call. It's unrelated to crypto though, but just maybe we can do it and then get right back to crypto right afterwards. The question is basically regarding dark pools and whether or not dark pools trade during halts. If anybody has,
they do not.
Yeah, my understanding is that they do not
at all. No.
Could you repeat the question? Sorry, I didn't get it.
So let me go back to it to read it exactly. Do dark pools trade during halts? Also, do ATSs trade?
Neither do. The only one caveat there is if there's any pending block transactions that are going through on an ATS, they can still process during. Now, and again, one more caveat. There are multiple forms of, to whomever was asking this question, there are many different criteria for a halt. Some are triggered by specific decline or increase in the market in any specific ticker, and some of them are more systemic. But I do understand that certain block trades can still go through on an ATS, but it's very rare.
But he's for the use of what? So for the use of shorting and creating selling pressure, is that what he's asking? Why he's asking that?
I know the person and having spoken to them before, I think the underlying question is like basically if there's a trading halt, can the institutions still play while we're locked out?
At this point,
I think at this point
right now.
I mean,
on the wall. That's what it is.
I mean, we've seen, yeah, us put in positions where it's like our brokers are put on position close only. So, and like, obviously Gary Gensler, if you read through whatever, that 32-page GME report,
whatever
he
that
basically was, ominous, like that is all kosher. You understood your risks when you decided to do business with your broker, and that's, your problem.
Right.
So
yeah, this isn't PCO. This is like the questions directly in relation to halts, I guess, because
to be honest, if a halt happens, if they allowed a halt to happen, either going up or down, or up actually, if they allowed that to happen, just think about it. Think about it. They will will use every single tool to stop that, right? And they will know that the SEC will take another 6 months to find out what the fuck is going on and blah 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 blah, and they will delay another day.
Yeah, well, halts work in both directions, right? So it's not just up. It's it's volatility halt.
Friendly, clarify what you mean by delay another day.
By litigation, just keep existing. Keep existing. not getting margin call, not getting liquidated, not
I gotcha.
not losing,
Right.
not having to close the positions.
Live to fight
I,
another day.
I,
Is his point.
I,
So,
Okay.
I think what Holt says basically is, they can, go down or go up if they want, and the brokers can bid on it too, and the market makers too. So we are retailers. We got no stake right there.
Well, I think it does create the interesting.
I think
As far as them being able to execute, because it's like, they can execute like right on the trading room floor as close as it can get, because that's where their computers are. Like as far as timing
but if
goes, it's like
they don't
no
use that
matter
tool,
what,
they use another one.
for us personally, we're going to be like whatever they're trying to do, like they can do it faster than we can. I mean, obviously, if a halt is a halt, but it's like as far as trading starting back up again, they're going to be able to execute those trades, faster before our, essentially our trades will execute. So, I mean, that is just something to take into consideration.
Extremely important point.
Yeah, like high frequency trading happens unless we use IEX, for example. Everybody's using IEX, but the rest they just jump the queue and then just
But to Leather's point, it doesn't really matter if we're trading on or off exchange. At the end of the day, they're still going to have the competitive advantage out of the halt to be able to jump in as the first trade. So that's inherent advantage.
Yeah, I mean the point there is about latency. And I mean, it's something I've thought a lot about, like during trading halts is, if you want to put in an order, like you've got that 5 minutes, that 10 minutes to kind of collect yourself, try to figure out what's going on, right? If you are going to put in an order and you are going to put in a limit, how much are you going to jump? Because it's not like you can put it in at the next cent and expect for it to get filled, or the next 5 cents and expect for it to get filled, right? Like if you want to get in on that next candle, like you basically have to calculate your risk tolerance to where you want to, either buy or sell, because you're not first in line. You're not even close to it.
Well, I put my latency arbitrage machine on so I can avoid all that.
Well, there you go.
remember
but that's part of what that's part of what the delimit case is about, right? It's not the crux of it, but I mean, if you listen to those oral arguments, I mean, that's a lot. Yeah, I mean, it's about the latency arbitrage and how the market makers are really the only ones that can take advantage of it.
200 faster than a blink.
I'm sorry. This has to be said. It's like, and I think that it's very important that we listen to the words like specifically as to oh my gosh, I can't. He's the devil to us apes. The Griffin, Kenny G, good old Kenny G.
KG.
No, so Kenny G in those congressional hearings when they were like discussing that, like he said, I mean, basically he only specifically said we do not preempt those trades. He did not say so he used very specific wording there, say we're not preempting those trades, but it's like to say that he's going to react.
But you don't
but
judge,
that doesn't mean that he's not.
Griffin for what he says.
He may, but legally he's putting himself some legal.
When you both speak, nobody can hear you there. So please go ahead.
No, and so obviously what Kenny G is essentially like alluding to is he never denied, not reacting to, the retail trading.
Right. I think it's also important to remember that when you have a stop loss, a limit, order, whatever it may be that's triggered, it goes on the book and they see it, before it actually happens. So if you have a stop loss in play at or about or in the vicinity of where something halts, in my opinion, not financial advice, your own due diligence, trust but verify, and make decisions you're comfortable with. But in my opinion, you're opening yourself up to being hunted. And if your stop loss is in the vicinity of the halt, for them to exit you out of your position as it comes out of halt. I've personally have had experiences where, I kind of learned that mistake the hard way. Wow, cool, it's going back up, to get all excited. In the meantime, you didn't realize they stop lost you out of your position right as the halt came out. 5 minutes later, when you're feeling good, you come to realize that you were sold out of your position 5 minutes ago.
Yeah, I think we've talked about that a lot. Like, there's a time and a place for a trailing stop, and unfortunately, like, you just everybody's got to figure out like where that time and place is for themselves, I guess.
But one second, I think we're missing a very, very important point in here, and is why does that halt happens on the first place? This is where you need to analyze if you want to see how it's going to behave. Now, at this point, in my personal opinion, the only way we can actually have a halt, right, is if those shorts are forced to be closed. Otherwise, they're just gonna,
Well, hold on.
Well, no. I mean,
are we talking
they're
about
exchange-based volatility halts.
Are we talking about long-term halts or volatility halts? Because they're both halts. I mean,
yes. But come on, the odds of volatility like halt to happen probably on the downside, but it won't really matter. The only halt that actually matters is when they are forced to close the shorts.
Well, all I have
that
to say is
realistically could only happen in like the NFT dividend, or all the
No,
DRS
you're talking about two separate things. A halt is just a pause in trading.
Yeah,
but why would we want to know that? I know the pause in trading when it goes up by a certain percentage or go down by a certain percentage, that is too much. It starts happening every 15 minutes or 30 minutes. I know the trading
right.
halts,
that's one type of halt. That's a volatility halt.
But how is that halt is possibly like really gonna happen? So I don't know why we want to know about that.
I mean, you can go back and look at any significant run in AMC or GameStop, and they're very prominent.
Or even look at DWAC a couple days ago.
Exactly.
But I will just wait and then keep going.
So say that again. What?
That you just wait and then keep the trading will keep going. It's just like a pause.
Yes, but this ties right into what Leather was just trying to address, and that's why I said extremely significant. We're talking about latency arbitrage and the fact that, yes, in the grand scheme of things, I see what you're saying, but an institution with the competitive advantage of being ahead of the latency is able to get into the trade first before anybody else after halt has finished execution, and that does have a significant impact on the ability to feed incoming data on the way back in and their ability to trade against it. So they're far more likely to be able to front run things in that regard.
Even more so, though, it's the idea that
isn't that what happened to DWAC? That's what happened to DWAC, right, in front of us. Because
yes, we were just on. So even more so, though, an algorithm isn't going to be phased by a halt nearly, if at all, to the effect that a retail investor would be. And I think that's the bigger concern, right? And not only is the algorithm phased, but in addition, the algorithm gets fed the information from the book before the halt is even lifted. So not only isn't it shaken in its boots, so to speak, when the halt is in place, but it already knows better what to expect after the halt's lifted.
And forget institutional funds. Let's just address the monkey in the room. A market maker has all of the incoming trades going into the halt and can trade against those trades right at the end of the halt. So it's very significant, and we've been watching it play out for months.
Yes, but that is assuming that during that halt, naked shorting is going to happen, driving the pressure down. Now, if you think about it, if you take all the shares out of the DTC, there will not be real shares to force and do those mechanics that easily.
Yeah, but it doesn't require synthetic shares or naked shorting to have a significant effect. They have a significant long position that they can dump on the market at strategic moments as well.
Yeah, I mean,
Bottom line is,
right.
bottom line
Go
is,
ahead.
Abe's been in this play, AMC and GME, long before they even thought about it, and that would annoy the heck out of them. And they still going 2 billion shares short, naked shorts. This is just, they don't understand, bro, in this play, and they can forget about it. They going home empty-handed on this blade. But when it comes to DWAC and stuff like that, they see the blade coming, and they had the news. Look what happened. They scale up and down, and then they just like when it halted. A lot of people, lost money. A lot of people gained money. So it's them. That's how they make money.
Yeah, that I completely agree in a lot of sense, but I just want to reiterate one thing. We're talking about the potential ramifications coming in or out of any form of halt, in this case, volatility halts. And, we bring up the variables that would make any sort of competitive advantage for an institution significant. At the end of the day, we keep talking about synthetic shares and naked shorts and all these things that are obviously to some extent a variable, but really tying back to my point about the market makers, they're the ones with the competitive data advantage and the ability to front run, and they can legally naked short. And so, I just want to make it very clear that when we're discussing topics about, the competitive advantage of an institution, yeah, I'm sure there's some fund somewhere, creating synthetic shares and derivatives and FTDs on the hedge fund side. But we really got to remember that the real crux of this are the market makers. And at the end of the day, a volatility halt is going to happen regardless of what play it's in. Like David said, DWAC, that wasn't even based upon shorting at all. And what we need to be on, and when I say on the same page, we're all individuals, but what we need to be on the same page about in terms of, the intellectual understanding of what's happening is they have data advantage, and we need to know that and make sure people are aware that they're going to do anything that they can within those moments to shake people out of the shares, trigger stop losses, and freak people out. And you just got to understand that that's the case.
But I mean, I think
honestly, when it comes to AMC, this game's over. We're talking about Abe and Citadel in front of each other, trying to share a stake, but this stake is just front of the Abe.
Like the whole time I've been obviously talking about those two entities in particular, which is Citadel and Virtu, because like David Lauder told us before, they have like over 70% of all the trades. They basically is a monopoly of the market, and yes, they can see it. They can even see the stop losses. They have all that data advantage. They have all the data pretty much at their disposition. So they will, unless they are forced to close their shorts, they will do whatever it takes to just manipulate the stock. See, hold, no hold, they will just do it and manipulate it. See, so our play is try to make them close the position. Close, not cover the position. Close. They need to close the shorts, return the shares.
Well, yes, and that's the case. But the thing again, I want to bring it back to is the majority of their ability to affect the share price at any moment given in time is not simply heavily.
In January, acted upon it, and to this date, have just stayed the course. It doesn't matter. And I mean, if anything, the charts show me they're the hardcore are holding. I mean, that's what the charts tell me personally. not financial advice, but I mean that's just how I interpret it personally, as just some smooth-brained retail trader, right? I'm just a dumbass fucking crayon eater, right?
But they have the
Anyway,
entire market. Think about it. They can't just manipulate as far, maybe as the just changing the price itself.
Yeah, well,
It's on the market.
Again, the biggest, that would, just to finish my last point in like 3 sentences, I was just going to say that, and by the way, Leather, totally agree. I really want to hammer home the ability of them to manipulate share price is far less about FTDs and synthetic naked shorts. It's about their ability to dump long positions, trigger stop losses that cascade into other stop losses, just like any other flash crash on whatever level you want to talk about it. And that's their strongest advantage.
Yeah, I agree.
They can manipulate it up and down.
The one thing I'll say is that, you know, through rehypothecation, that's also a huge pool for them to pull the shares to dump. So if they don't have long positions to work with, so to speak, they in essence have an endless supply if they want it.
It's like it comes to the point that you always go one layer ahead of that. They can manipulate going up, going down. They can use the actual real shares, right? Create naked shorts and sell it on the dark pool, creating only selling pressure, and then use them again to buy and create buying pressure. Like they can do whatever they want. They are the market makers. It's in the name.
Well, they can't do anything they want, but I do echo your sentiment about paying a traffic ticket is nothing to them, and they're going to continue to play nefarious if that's the only penalty and the cost of doing business.
That's what they buy them time. That's them buying time. That actually pay for that service of getting more time so they can steal more.
Well, Kringle's not here, but I want to echo a point that he makes often that I think is also important to this discussion. We're talking about the dynamic between retail long funds versus market makers and other funds that are short, and that is significant. But a big part of this puzzle is the cyclical nature of creating liquidity through cyclical patterns, allowing the thing to run up and down in a way that allows them to hedge themselves against other parts of the scenario. And so I don't want to forget that because it carries just as much weight.
The thing is, like, what I'm thinking is that all these issues, we have like zero control of what to do on this. I think after all the DD, we kind of like understand the mechanics behind it, like what we need. But in order to solve this, I don't think that I don't know, getting into the details and assumptions a lot, because we really don't have that data to confirm. No one is gonna come here from Citadel and tell us, yeah, that's what we're doing. It's pretty hard to get into those, you know.
Say that last part again. It cut out for me. I apologize.
Comes to the point that this is the information and the actual data mechanics that we can't control. We can't control any of this, right? But then also we are basing a lot of this in assumptions. Yeah, we see it on graphs, we see it on the tables, but there's no one that is gonna come here and tell us like, or someone from Citadel telling us like, hey, this is exactly what we're doing. Yeah. So based on these on assumptions, but then also having this information really is not gonna help us that much to solve the issue.
If I may interject, I would say it's not our issue to solve per se. I think that's a much larger abstract discussion involving, you know, lawmakers, Congress, things that will take, I'll never see in my lifetime, and I'm in my late 30s. Okay. However, I would like to argue the point that clearly, at least in my opinion, something that retail is doing is working. I say this, one, because we saw Citadel not tweet for I forget how many months, an extended period of time, and then the Twitter account blew up in like rage tweets. Okay, secondary to that, their legal team became very aggressive. I can only speak for myself. I know of others. Um, they were very aggressive with me. They are still very aggressive with me. I'm dealing with it now. So clearly, a nerve has been struck. Now ask yourself, why would they suddenly rage tweet? Why would they suddenly go on this PR campaign? Why would they kick their legal team into overdrive and come after, CitadelAir, come after other YouTubers, come after other accounts, come after, other people have reached out that are facing the same or similar situation, if not worse, that I'm currently in, that hopefully I'll be able to share at some point. But I mean, it is. I'm going to describe it as vicious legal prosecution. So I ask myself, if the psychology behind this, clearly a nerve has been struck. It's not just that someone's upset because someone they got memed by me. Okay, it's that it wasn't defamatory. It wasn't libelous. Um, it's clear that we're striking a nerve, that possibly we're hitting something on a level of truth that's resonating, and it's concerning. So what is what is one of the last things in the toolkit when they're backed into a corner? They fight
1
back
second.
with lawyers.
Well, when you have
Is
when you have a hypothetical fund, I'm just going to say hypothetical to make this point.
Please,
Yeah.
hypothetical, yes.
Yeah. When you have a hypothetical duopoly fund as a market maker and hedge fund that hypothetically has very valuable clients with varying political affiliations and varying confidence in this hypothetical fund, and you have an administration who is very arguably hypothetically not in favor of such leadership of such fund, you're going to do anything you can hypothetically to stop your potential fallout that could ruin such hypothetical fund.
Correct.
but it's also sorry, can I?
What I'm going to underscore, though, is I agree with you 100% under normal circumstances. But I think in this hypothetical, this is abnormal because retail has not, presented such a challenge before.
No,
So yes, it's partly damage control, but I think also this can't be sustained indefinitely in this hypothetical model we're talking about. I mean, you can kick the can and kick the you can kick the can, but it's the inevitable is going to occur at some point.
No, it's because we are a threat for them, not just because of our awareness. It's because of the numbers. That's where the power is. That comes from my original point. The power is on the people, where the people put their trust and their money, not just their investors, everybody around it. If the word keeps getting spread and everybody knows that that company is doing that, they're going to try to stop it too. If this keep growing and people will move their funds and their value to another place, that will ruin that. Because that's the power. The power is where the money is.
Right, and I'm not proposing that anyone do that or take any punitive action against any hypothetical hedge fund, such as moving their money away. My point is that my opinion is that the reason why we're getting closer to the end game per se, because in my experience professionally and if I was to step back and treat this like clinically on a psychological level, this is one of the last fear responses, fight or flight, and it's one of the last things in your business toolkit for triage. If there was no validity to any of the DD that's out there hypothetically, or anything that retail is doing, if that wasn't even remotely valid, we would be being laughed at. Just like when the bailouts occurred, there'd be champagne flowing. They would be laughing. Look at all the stupid retail money out there. They think this is going on, but this is hilarious. But no. Instead, they're taking a very defensive posture. They're lashing out. They're attacking, and they're being very aggressive about it. So to me, that signals, in my opinion, that a nerve was hit. It's not just about image and being memed. It's that there maybe is some truth to what retail's been saying all along. It's gaining traction, and it cannot be held indefinitely. It is in the paperwork that I may or may not have received. It is not about slander or libel or defaming the hedge fund, hypothetically. It's about separate, separate things altogether, just to shut hypothetically, or shut someone up.
If this
But
fund was hypothetically pursuing potential action against a hypothetical person, do you think they would hypothetically be targeting this other hypothetical person for completely unrelated topics to try and put a quash on them?
I would say it's arguable that there was 14 separate immaterial points that they hypothetically served on someone in a complaint that was nearly 150 pages.
That's what I figured.
So it was, like I said, it wasn't slander, it wasn't libel.
Sounds like hypothetical extortion to me.
In a roundabout way, I think from what I've heard from the hypothetical lawyers out there, is that it's a slam dunk and there's nothing that the person should worry about. But my point is that I think a nerve was struck, and it's not just a particular individual or account or website. I am aware of others that have expressed the same hypothetical situations, saying, "Oh God, what do I do? If this were to happen?" And it's like, well, if this happened to me, I can't really talk about it, but this sounds similar, and so it's not isolated. To me, it signals that. I'm not saying the end game's here, but this is much further down the line than as if this were, complete farce, that there was nothing to it, there was no credence, and it wasn't even remotely possible. If that were the case, again, they would be laughing and not spending money on legal and buying more mayonnaise and actually fueling the jet up.
1 second. Listen, if you look at the actual public, right? People right now, and this comes from the original point of inflation. People drive people into find other ways to make easy money or investment or try to multiply that money, because working is not literally working. It's not doing the job, right? So they are gonna always resort to an alternative. Right now, because of inflation, because of they're being choked, they are looking at different avenues, and now they're recurring to the internet. See, that's where we have two avenues. The people that know how to use the internet, that they are mostly critical thinkers, gamers, that we resort to more fundamental and more logical behind it. But there are the other way, that they are a little bit more lazy or doesn't understand or doesn't feel capable, that listen to the mainstream media. So you have these two polars, right? That's where the amount of people and trust is, like big amount on those two groups, pretty much. So this is being come from inflation. If you think about it, this is now resonating to the elite, starting to resonate, and more. The more inflation, the more is going to happen, and the more truth are going to find of all those hypotheticals we've been talking about. Because the more people put time and effort in it, the more gonna find. The more eyes on it, the more power. The more people, the more power. Because the power is on the actual people. See, our brains. That's where the real value is. The fundamentals of humanity. See.
Hey, what's going on? Can I say something really fast, guys?
Absolutely.
Basically, from what I see, and I'll speak for myself, so I'm not going to tell anyone what to do or how to do it. I'm just telling you my thoughts on this situation. In the beginning, a lot of people got wrapped up in like GME, AMC, like a lot of like these so-called like meme stocks, because they saw that they were being shorted. And over time of holding these stocks, we've come to notice that there is a lot of fuckery in the market, and it goes strongly against retail no matter how you cut it. And it led people to start doing DD. And the more DD that people did, the more they saw that these hedge funds and market makers and bad actors were bending rules to fit them, not retail. And the more we dug, the deeper it got, and the more we saw just how corrupt it was getting. But it was actually really beneficial because it taught us as retail the two smartest or the two wisest things to do, in my belief, which is if you want to and you could afford to, continue buying and hold it. And it sounds so simple and it sounds so stupid. And I'm not saying that there's not more that you can do, but the two basics are buy and hold. And that's what's really killing them, because as a play on words, they went short on these stocks and they weren't expecting retail to go long. So while we sit here thinking like we really want this to happen like yesterday, it's more beneficial if it continues, because the longer it goes on, the deeper the hole they dig to continue playing the game. And there's a famous saying from a book that everybody has read, I would assume, there's like The Art of War by Sun Tzu. And he makes a statement in it saying, never interrupt your enemy when he is making a mistake. And the thing is by buying and holding, like I said, those aren't the only things you could do, but they are the two most basic. By doing that, we're pushing them into a corner where they have to continue bending rules and digging the hole. And we continue letting them do that. We continue letting them do that. And eventually that's what's going to break them. Not necessarily us as retail doing what we're doing, but by them doing what they're doing to continue the game. Because the only thing that they have on their side is pride. And the thing is inflation, exactly like Friendly has stated, has led people to go other places to try and hustle, try and make a buck. And they never thought retail would get into the market the way we did. And they never thought we would learn the market the way that we did. And that was their number one mistake, was thinking that retail was always going to be dumb retail. And instead, we all went on the internet. We all did DD. We all got together. We all passed around ideas. And we know what's going on. And by continuing to buy when you can, if you want, I'm not telling you what to do with your money, and holding, not giving up, not giving in, not telling you what to do, I'm just saying what I'm doing, that's what's killing them. That's what's crushing them. That's what's winning. And that's why they're so bent out of shape right now, because they never planned on it. They never expected. They thought we could run these up really high and then tank them, and people would see it and they'd be like, oh no, I can't lose this money. I need to get out. And they'd sell off and they'd be fine. But we screwed them because we just continue to hold. And that's what's really doing it.
We understand the mechanics of the games, and the mechanics of the games, like that movie Margin Call had this note, right? This scene in which they say the risk increase when the music slows, when the market slows, when there are not enough supplies, the risk increase with the demand, right? But they were saying this is just bad when it starts slowing. Right now it starts slowing, but when the music stops, when the wheel stops, that's when everything starts to happen. So we are slowly choking them into that corner until the music stops. That's when they gonna be fucked.
And I agree, because like seeing the volume go from like 100+ million trades a day to like 50 million, 20 million, 15 million, that's how you know you're getting somewhere, because they're at a point they can't do anything because there's nothing to buy. We're not giving them that option to cash us out and buy back what we have and win. They have nothing to buy, and that's why the volume is drying up. And that's what you want to see. You want to see the volume drying up. That means that we're getting somewhere.
Totally. And another significant indicator is looking, and this is something actually Sam had brought up. I'd been following a few months back, but wasn't totally convinced. But at this point, I think it's really significant to look at the dark pool liquidity volume right before every run up, because they have direct correlation almost every single time. But that's when we come back to the actual crypto, because the other way that the music is going to stop at the same time, or could make it stop, is with the NFT dividend. And that makes complete sense of how the mechanics of the whole thing works. And that's why I want apes to focus a lot on what's come next, on the future, to start learning about that new market.
Most definitely. Cryptocurrency, NFTs, anything that's like that is what people should be like considering for the future. Like moving forward after whatever happens. That's where people should be putting their interest, because right now the market that we're playing is very, very rigged.
I would like to teach you all about that world, especially the Web3 world, the metaverse world. I've been studying a lot on that and talking to most people that they are like, including Fubar, including Kindleborg, like people very influential of it, because I'm too curious. So I just keep asking and asking these people and understanding the mechanics of it, how the roll-ups work, for example, against the optimistics, or like all these, the whole NFT like protocols as well. It's very important for us to just see those little mechanics, and I'm able to explain it in a very basic, simple way. If you guys want to learn that, because that is a very, very amazing.
I'm not sure if anyone else has questions or contributions, but considering we're well over 3 hours at this juncture, and I have to be up in 3.5, 4 hours, I think we're looking at probably wrapping it up, but happy to entertain any last minute questions, comments, concerns. If anyone wants to send David some Hot Pockets, Carpe Diem, now's your time. I suspect David's asleep.
All out of question.
I really enjoyed the conversation, so thanks.
Thanks for joining. Kenna is off this week from the Bull House, so I think generally I'll be on most of the week, and Halister's quit his day job to handle this at night, so he'll obviously be on as well. But I wanted to thank Kringle, obviously is no longer here, but thank him for joining, Dave, Halister, etc., all the other folks that popped in for the conversation. I honestly planned on it going for an hour, but got a lot of positive feedback from folks saying they enjoyed the conversation, learned quite a bit. So I will throw out a tweet tomorrow as to what to expect from the Bull House podcast tomorrow. I know David and I have something popping off earlier in the evening
at 6.
At 6. Yeah. that's been tweeted out. It's on his Twitter. I think I sent something out about it, but Full House will be doing something later, and then I think I've got something lined up, some interesting lined up guests for Wednesday. So stay tuned to that for sure. Unless there's,
for the record, I wasn't sleeping. I was just on the other side of the room, but I was listening.
Sure, you were.
Thank you guys for providing this opportunity. It's the first time I talk about this, like other than my friends and stuff. And thank you for doing that, and hope you guys have a good time. Good night.
No worries, amigo. We appreciate. It's always good to have learn something new. But especially there's an immense amount of stuff in the crypto world, and it's always I always enjoy hearing opposing viewpoints. So thanks for joining us, and I know I learned a few new things this evening. That's for sure. And most importantly, I got a kick-ass cheesecake recipe that will be made tomorrow. That's all that. That's all my takeaway.
You better meme the fuck out of that cheesecake.
Yeah,
as long as it helps everybody, is happy.
I have to figure out how to video render in a proper meme for the cheesecake, but I assure you, it shall be done.
I love it.
All right, folks. It's been a pleasure. I will catch you all